Professor Reiner, start with you. Some in the crypto industry have complained about recent SEC enforcement actions against crypto firms for offering unregistered investment products. Some of these companies entice consumers to put their crypto to work to earn double-digit returns. Shouldn't a financial product that takes in billions of dollars in retail consumer money operate with basic consumer protections?
Yes, it should, Senator. And I would point out that the crypto industry is very fond of criticizing the SEC for regulation by enforcement. But the truth is that it's just a catchphrase that the industry uses to deflect from the fact that they've willingly chosen to operate outside the regulatory perimeter. And the SEC has been quite clear, going back to the chairmanship of Jay Clayton. Most cryptocurrencies are securities that need to be registered with the commission. And the SEC has filed over 125 enforcement actions, and they haven't lost a single case related to cryptocurrency. So the judges think it's quite clear as well. The only people who seem to be confused about this is the crypto industry.
Thank you. Professor Yadav, your testimony discussed how stock exchanges are regulated, how to extend similar safeguards to crypto exchanges. What are the established safeguards that can benefit consumers, that can increase market transparency and prohibit conflicts?
So, Senator, thank you so much for that question. Stock exchanges have been providing self-regulation of this market for a long time. And I think it's important to consider the counterfactual here, which is that these extremely powerful, extremely central, extremely important parts of the institution, what would happen if they weren't required to do so? And what we have here is essentially a marketplace in which we are using the private self-interest of these exchanges to provide a public good. Now, in the context of the exchanges themselves, what they do provide is having having expertise within the marketplace to surveil trading from a very proximate standpoint. They are responsible for enforcing under Section 6 of the Securities and Exchange Act standards of preventing fraud, manipulation, and to create a fair and equitable marketplace. Now, certainly this oversight is not perfect, Senator, but at the same time, it's better than what we would have if we didn't have it. And so in this context, there've been various steps taken in the context of preventing these conflicts of interest. So, for example, entity separations within these exchanges. FINRA is another organization that is there to prevent potential conflicts from occurring. And so overall, this is a system that provides a complement to public oversight rather than necessarily being any kind of substitute for it.
Thank you. Mr. Reiners, again, the collapse of FTX has focused attention on basic protections like safeguarding customer money so companies can't use it for their own personal benefit. Explain briefly the urgency to us, the urgency to develop better standards for the custody of consumer assets.
Yes, Senator. So unfortunately, millions of Americans have found out that if they've used the crypto exchange and that exchange has failed, they are now unsecured creditors in that bankruptcy estate. So they do not have control or access to those assets. Of course, that's very different than the situation we have with banks, which are FDIC insured, or with traditional broker-dealers, which are subject to SIPC insurance. So if there's going to be one change that I would recommend Congress focus on, it'd be requiring these crypto platforms to segregate customer assets from firm assets so that if these firms do get into trouble, customers will still have access to their funds.
Thank you. Last question I would ask all three of you to answer. There are many ways to protect consumers in the crypto market. One thing is clear, that customers deserve to understand better the investment they're making. My question for the panel, without debating the ways cryptocurrencies are different from stocks or bonds, is it reasonable to start the conversation with the investment disclosures that we're familiar with? So, Professor Yadav, start with you. Let's go down the line. Each of you briefly explain how we can use existing disclosure principles for crypto.
Senator, I'm so glad you asked that question. This is an essential part of the process, which is to have disclosures reveal insight about what exactly the governance is of the issuers that are providing this technology, in addition about the blockchains, as well as obviously the underlying technologies that are animating these offerings. Now, what we have here today is a disclosure system that needs to work. As Ranking Member Scott discussed earlier, this is a technology that has been popularized and is being used by increasingly younger people, folks in minority communities. And so it's extremely important not just to focus on disclosure, but also literacy, making sure that these disclosures work. I have a terrific co-author that has done work on making sure that disclosures are readable, making sure that disclosures are usable, encouraging people in different ways to engage with the actual information they're seeing. Otherwise, just having a thick bundle of information does no good whatsoever if it's not something that is able to communicate these risks and opportunities effectively.
Thank you. Professor Jang?
This is a very important question. one of the very interesting issues about this is that it is transparent in code, right? But as a former regulator who worked with blockchain engineers, and I do not code, I need the engineers to actually explain to me how the product was actually designed. So white papers that clearly explain how it's designed, what the risks are, who holds the private keys, the governance, the voting rights, and then more importantly, where are the funds held? These are the important issues that need to be included in the disclosures.
Thank you, Mr. Reinders.
Senator, we've had a basic bargain in our capital market since the 1930s, and that is that companies that want to raise money from the public have to disclose the risk involved in that. And then investors are free to choose what risks they want to take. And so I see no reason why that principle shouldn't apply to crypto, although I'll agree with Professor Yato's point that maybe the specifics of what gets disclosed can be debated, and I think the SEC does have the authority, and I think Congress should give them the authority to draft customized disclosure regimes for certain decentralized crypto products, and the EU is moving in that direction, but disclosure is necessary.
Thank you. I guess the $54 million of Super Bowl ads a year ago and 0 ads this year sort of underscore that. Ranking Member Scott.
Thank you, Mr.
The
Chairman.
member has a unanimous consent request, briefly.
Thank you, Mr. Chairman. I would move that Senator Lummis' statement be included in the record.
Without objection, so ordered. Thank you. Start with Dr. Dietz and Dr. Herbert. We heard from the two of you and also from Mr. George that we need more housing supply across the board. Dr. Dietz, what are the types of housing where we see the greatest shortfall? You mentioned in your statement it's almost impossible to build affordable rental housing without a subsidy. What people are most likely to be priced out? And speak about that for a moment, if you would.
Yeah, when you talk to builders across the country and prospective home buyers, the tightest part of the housing market right now remains that small lot, entry-level construction that is appropriate for a first-time or a first-generation home buyer. So when you look at the data, more than 10 years ago, back in 2010, about 32% of new homes being built were under 2,400 square feet. That 32% share has now shrank to about 24%. So we've seen a marked decline in that entry-level construction. And then the impact, it is harder for those younger households to attain home ownership. So the result of that, of course, then is people renting longer, which is one of the reasons the rents are higher. And then we've had a near doubling of young adults who live with their parents over the last 20 years.
A doubling.
A doubling. It's gone from 1 in 10 25 to 34-year-olds to 1 in 5.
And that's over a 20-year period.
That's over a 20-year period. So these are longstanding issues.
Dr. Herbert, comment, if you would, on my question, your thoughts on it.
Yeah, I would agree with what Dr. Dietz said. I think the shortage of single family, particularly starter homes, is really important. He used the metric of 1,800 square feet. If we go down to 1,400 square feet, that was a very common home in the early 80s, and now it's low single digits. I was talking with a home builder, national home builder the other day, who specializes in this segment of the market, and they were saying there are communities that will mandate that the smallest house you can build is 1,600 square feet, so they can't even build their entry-level house in that market. So that restriction on building those starter homes is key. Dr. Dietz has also talked about the need for more townhomes and condos. That's a segment of the market that has really been missing, too, as an affordable entry point. And I would just also highlight the need for more modest-cost rental housing. What we've been building mostly over the last decade has been very large, prime location, multifamily housing downtown, which has been needed, but it's very hard to build at an affordable price point there. So it's really, we need to have lower density housing in the suburbs, but still making use of land that provides a kind of garden apartment style housing we used to build, more modest rental housing as well.
That comment you made about 1,600 and 1,400, I would, not in this hearing now, but I would like to explore that more with you, that it could answer some of these problems, I think. So pretty interesting comments. Dr. Herbert and Mr. George, you both talked about home repairs as a tool to help lower income homeowners and seniors. Talk about the benefits of home repairs, most importantly, what resources can make those repairs affordable for families with limited income. Start with you, Mr. George, then you, Dr. Dietz.
Thank you, Senator. I think home repairs are important, particularly to older population in the United States. And as you know, the population in rural America is just older than the nation as a whole, and is maybe a harbinger for things to come nationally. But oftentimes, older Americans need resources and the ability to repair their homes. And I think there are several resources that come to mind. One notably, I would like to reinforce from the work that the Housing Assistance Council does, is that capacity among local housing providers is extremely important. So they are oftentimes the local housing nonprofits are the connective tissue or the catalyst that help to turn these resources into affordable homes and supply those vital home repairs. So I think capacity at a local level is important. Also, I would just quickly mention USDA Section 504 Home Loan and Rehab Repair Program, which has assisted hundreds of thousands of rural homeowners across the United States and is particularly important to older homeowners. So those are a couple of quick resources.
Thank you, Dr. Dietz. Your comments.
Yeah, the remodeling sector is absolutely critical as part of the reinvestment strategy. As Dr. Herbert mentioned, we've got an aging housing stock. The typical home in the United States right now is about 39 years old. About 15 years ago, it was kind of in the low 30s. That's a pretty dramatic increase in the period of time. So if we're looking to improve the housing stock, improve energy efficiency, improve resiliency, making sure that remodelers have access to skilled labor is going to be key. Remodelers like to say, not only do I have to find skilled workers, but they have to work in someone's home. So finding those additional workers is important. And I think policy tools can play a role. The Section 25C and 25D energy efficiency tax credits are good tools, but making sure that people can access cash out refi mortgages to get capital, reinvest in those homes. That's really where the low-hanging fruit is when it comes to improving our housing stock.
And Dr. Herbert, would you answer that question too? But I want to, just because time's limited, if you'd work in an answer to this question also. I've co-sponsored the Bipartisan Eviction Crisis Act with Senator Portman, my colleague who just retired from Ohio, Senator Young and Senator Bennett, offering ways to reduce the number and impact of evictions on the lives of families across the country. Matt Desmond has written about it. And so if you would also answer, what lessons can we learn from the Emergency Rental Assistance Program as we continue to work to reduce evictions?
Thank you, Senator. Briefly on the remodeling question, I would echo what my colleagues have said and highlight the fact that we have an older housing stock. We also have housing that is in need of energy retrofits. And as you mentioned in your original question, an aging population that needs housing that's adapted to meet their needs with mobility and other ways to keep them safe. In terms of how, I would highlight the importance of grants, particularly for very low-income households who may not, particularly elderly households who may not have the ability to take on loans. And I would also highlight the need for technical assistance for people to be able to assess the need and help find a contractor and make sure the work is done well. In terms of the Emergency Rental Assistance Program, I think it's really, the evidence is quite clear that the program was enormously helpful in keeping people, keeping renters in their homes, and at the same time also enormously helpful for landlords who were suffering from lost rental payments. More than 3 million renters have received assistance from that program. It's been remarkably well targeted. Some 2/3 of those assisted have been earned less than 30% of area median income. Another 20% earned between 30 and 50%. And what we saw during the pandemic, enormous concern that we were going to see evictions go through the roof. And what we found from the data from Eviction Lab in Princeton is that, in fact, evictions stayed very low, in part because we had a moratorium, but that emergency rental assistance was really critical in making sure that people could stay stably housed.
Thank you. Those comments are really important. Senator Scott. Senator Scott. Sorry.
That's fine. Good morning, Chairman Powell. Sitting here, looking at my prepared remarks, thinking about, there's an opening coming where Vice Chairman Brainer's moving on. I think it's really important for us to make sure that all the information that we need in order to make a good decision on the next nom that we have in a timely fashion. So I would really implore the chair to make sure that happens, that every question, every questionnaire that is asked from the person, we get. Every member of this committee has their questions answered in a timely fashion, and that the staff has their answers in a timely fashion. Listening to Chairman Brown, I thought to myself, fascinating, truly fascinating. I concluded that, well, I know Chairman Brown pretty well. I am sure he is sincere in his rant. But let me just say this. Spending and printing trillions of dollars, caving to the radical left in this country, seeing policies posited and then implemented that led to the worst inflation in 40 years, seeing our inflation at 9.1%, seeing American families struggle because of the weight of the government on their shoulders, seeing the devastation from South Carolina to Ohio. It's unbelievable that the progressives in this country who caused a 9.1% inflation would then turn somewhere besides in the mirror to see the absolute devastation caused by their out-of-control spending is remarkable. Remarkable. To stop the out-of-control inflation caused by the out-of-control spending, the Fed steps in to cool the economy. Well, the definition of cooling the economy is necessary because we've seen the most radical approach to a problem that was in our rearview mirror being used as a Trojan horse to bring in a level of socialism and spending that our nation has not seen in my lifetime. The facts are very simple. When you get to 9.1% inflation in this nation, as a kid who grew up in a single-parent household, mired in poverty, a 40% today, 100% just a year ago increase in the gas prices devastates single mothers around this country. For seniors on fixed income whose savings are being depleted with an average cost just last month of a $433 increase because of inflation. For my friends on the other side of the aisle to look any place besides a mirror, I find stunning. The truth is that when your food prices go up over 20%, when your electricity is up over 20%, you have to ask yourself, where in the world are they? They cannot be in this universe. It must be an alternate universe where, in fact, it's okay for us to see prices go through the roof and our economy not stumble, but fall into a ditch. Why are we in the ditch? Because progressives used the pandemic as a way to usher in a form of spending that takes the money out of the pockets of everyday Americans and puts it in the coffers of the government. There is a better way. The better way is to trust the American people. And when you do so, we don't have to have the Fed come in and raise interest rates so high to quell the challenges in our economy so that today versus 18 months ago, the price of the same house for your mortgage payment is twice as high. Why? Because of the runaway spending of our friends on the other side of the aisle. I'm sure I do not have time for my opening comments, but I will say without any question, as I look around the country and I ask myself, how devastating is it that today it costs $433 more than it did a year ago? The answer is it is a crisis. When the average family in our country just a couple of years ago didn't have $400 in their savings for an emergency, to have prices go up by this amount, it's devastating. To have a conversation about rents around the country, looking at the inflationary effect and the absolute devastation of a snarling supply chain that we haven't seen in my lifetime, run by my friends in the progressives. Unbelievable. But to get to you, Chairman Powell, one of the comments that you've made that I think is really important in one of the speeches you gave in January, and I apologize for my rant. I just wanted to make sure my rant was consistent with my friend here. It is essential, you said, that we stick to our statutory goals and authorities, and that we resist the temptation to broaden our scope to address other important social issues of the day. Taking on new goals, however worthy, without a clear statutory mandate would undermine the case of our independence. You further noted that, and I quote, "Without explicit congressional legislation, it would be inappropriate for us to use our monetary policy or supervisory tools to promote a greener economy or to achieve other climate-based goals. We are not and will not be a climate policy maker." Do you still stand by those comments?
I do.
Thank you. Finally, I know we're not in the question. I know, I get it. Finally,
You now have 4 minutes and 12 seconds.
yes, I knew the chairman would dock that from my time, and I appreciate you doing so
With a sense of humor.
with a great humor. Great humor. Finally, several of my Republican colleagues and I sent a letter to you discussing Vice Chair of Supervision Michael Barr's plan to conduct a holistic review of capital standards. I look forward to discussing those capital standards during my Q&A, and I will thank you for our recent conversation that we had that helped illuminate some of the necessary challenges that we face as a nation and your answers to it. Thank you, Mr. Chairman.
Thank you. Order. Apologize to the witnesses and to the observers today, both in person in the committee room and those watching remote for the delay. Senator Scott and I were at a briefing. We won't talk about any more than that on what's happened with China and what's happened with the balloons that the military and others have protected us from, if you will. So we needed to stay and at least hear the generals make their remarks to us. What a difference a year makes. Go back to last year's Super Bowl. The cryptocurrency industry spent a whopping $54 million on 8 ads promising Americans untold riches and the chance to make history. Of course, they didn't tell us about the high fees, the risk of loss, the outright theft that plagued the crypto industry. But if you watched the Super Bowl 2 nights ago, you didn't see a single ad for crypto. The cryptocurrency industry has imploded in 2022. The crypto market lost $1.46 trillion. That's 1.46 thousand billion in value. Hackers and fraudsters, often tied to the regimes in Pyongyang and Moscow, have stolen over $3 billion. Crypto firms have slashed over 1,600 jobs. And as crypto values crashed last year, platforms began collapsing, creating more losses across the rest of the crypto ecosystem. The crypto firms that are left have had to halt customer withdrawals, freezing people out from their own money. While crypto contagion didn't affect the broader financial system, thank God, we saw glimpses of the damage it could have done if crypto migrated into the banking system. The handful of banks with close ties to the crypto industry have needed liquidity lifelines after they suffered large withdrawals. This crypto nightmare isn't over yet. We're still learning the full extent of the fallout from the FTX collapse. In December, this committee heard about the excessive risk-taking and misconduct at FTX. The customers who lost money are only now understanding the reality of the products they were sold. As these crypto firms filed for bankruptcy, regulators and policymakers have also learned how out of control some of those businesses were. They were over-leveraged, they were undercapitalized, they had no internal risk controls, they were careless with customers' money. In the case of FTX, they used it to line their own pockets. Now the money of millions of Americans is trapped and they might never get it back. Last year, I warned that the splashy Super Bowl ads left out key details. A year ago, I said, as chair of this committee, big crypto companies are looking to make big profits, are desperate to reach as many Americans as they can, hence the $54 million in ads at the Super Bowl. They brought in celebrities and gimmicks to make crypto sound exciting and daring and profitable, immensely profitable. But these ads left a few things out. They didn't mention the fraud, they didn't mention the scams, they didn't mention the outright theft. The ads didn't point out that you can lose big in crypto's huge price swings. They didn't tell you about the high fees pocketed by the crypto companies. And they sure didn't explain that crypto markets lack basic investor protections and oversight. The results were as predictable as they are tragic. Contrary to crypto evangelists' claims of democratizing finance, contrary to crypto evangelists' claims of democratizing finance, it's not the early adopters or the big money investors left holding the bag. When it comes to crypto, it turns out fortune doesn't favor the brave. It favors wealthy insiders. It's not just about a few bad actors that didn't do things quite the right way. These crypto catastrophes have exposed what many of us already knew: digital assets, cryptocurrencies, stablecoins, investment tokens, or speculative products run by reckless companies, we know that's true, that put Americans' hard-earned money at risk. Not surprising from an industry that was created to skirt the rules. Whether it's Facebook, Libra, or the explosion of crypto, I've always been concerned about shiny new products that really just offer another way to profit off the backs of working Americans and at the same time threatening the real economy. It's time now to consider how to protect consumers from unregulated digital assets and ultimately whom we want our financial system to serve. Last Congress, this committee examined the risks of crypto to our economy, explored the mechanics behind stablecoin companies, looked at how regulators in Congress can protect consumers. We learned how crypto can be used to commit crimes like drug running and human trafficking, which threaten our national security and help fund terrorists and rogue regimes. We looked at how fraud and speculation in the crypto market hurt investors and savers. Recent crypto meltdowns have made clear we need a comprehensive framework to regulate crypto products to protect consumers and our financial system. Today, we'll examine how time-tested financial safeguards can help protect against the harms and the risks of crypto products. We'll start by taking a closer look at these basic principles of regulation. Clear disclosures and transparency essential so retail customers and investors can understand how a token or crypto platform works. Prohibitions on conflicts of interest and self-dealing by insiders is fundamental. Our markets only work when they work for everyone. Protecting consumer funds by separating them from company assets, investor dollars, can't be a slush fund for the executive's benefit. Internal governance and risk management to make sure if a platform takes customer funds, it acts prudently. Strong consumer and investor rights and protections that are foundation of trust in any financial system and central to a functioning market. Anti-money laundering and fraud prevention to make sure that malign actors and evil nation states can't fund themselves and evade law enforcement. Oversight and supervision to hold companies accountable because access to our financial markets is a privilege, not a right that can be abused. These are basic common sense principles that have developed over centuries of financial system regulation. The wildcat money of the 1800s, the repeated banking panics of the Gilded Age, the 1929 stock market crash, the savings and loan crisis in our lifetime, the dot-com bubble, the great financial crisis. These crises are the story of speculative bubbles fueled by investor euphoria and the promise that this time it's different, even though it really never is. The lessons learned are the product of hard-earned experience born of real people losing real money and of real dreams shattered. Crypto isn't special. We can start with these common sense principles as we consider a regulatory framework for digital assets that puts consumers first and, above all, keeps our financial system safe. I trust this committee, as the ranking member often says, can find common ground and work together to protect investors from crypto risks. Ranking Member Scott.
Thank you.
I'm excited to hear today what public transit means to people in Cleveland, Ohio, in Greenville, South Carolina, and in Baltimore, Maryland. Thank you to the witnesses for being here. For that, I want to say a few words about the people in East Palestine, Ohio, in the aftermath of the Silicon Valley bank collapse. They both have one thing in common. Companies followed the Wall Street business model, obsessed with short-term profits at the expense of everything and everyone else. They were aided and abetted by corporate lobbyists and the politicians here who do their bidding, weakening rules meant to protect the people whom we serve. And now working people in Ohio and around the country pay the price. As the nation knows, East Palestine is a tight-knit town in Columbiana County near the Ohio River, near the Pennsylvania border, which once made 80% of all the ceramics in this country. Before those jobs, like so many in my hometown of Mansfield, and others moved overseas because companies pay less overseas. This town, neighboring communities in Beaver County, Pennsylvania, Senator Fetterman, a member of this committee, the state he represents, are the kinds of places too often forgotten or exploited by corporate America. Now these Ohioans are worried about whether their water is safe to drink, whether the air is safe to breathe, whether their beef cattle can now sell a side of beef, whether their kids will get sick, and of interest to this committee, what happens to the value of their homes, all because of a train derailment caused by a corporate culture of cutting corners and cutting safety rules. Norfolk Southern chose to invest much of its massive profits in making its executives and shareholders wealthier at the expense of Ohio communities along its rail tracks like East Palestine, Steubenville, where there was a derailment, Sandusky, where there's a derailment, Springfield, 200 cars derailed since East Palestine. The company followed the Wall Street business model, boost profits and its stock price by eliminating more than a third, 38% of its workers over 10 years, then spent $3.4 billion in stock buybacks, and we're going to do more when this accident happened, instead of investing in its workers and investing in safety. Senator Vance and I have come together to introduce our Railway Safety Act to make trains safer as they go through communities like East Palestine. We're working with the Commerce Committee to move that legislation forward quickly. For decades, the railroads have lobbied to undermine safety rules. They're fighting basic requirements like having 2 drivers, 2 engineers, 2 pilots, if you will, on these trains. 2.5-mile long trains, 200 cars. The railroads want only 1 human being on that train driving it. Think of that. The railroads think that a train more than 2 miles long needs only 1 crew member. We know what it's about. Cut costs to boost profits, something you can't do in your jobs. The communities along their routes be damned. It's the same story with Silicon Valley Bank, and we will have hearings about that soon. For as long as we've had big banks, they've had too much power in this town. Think of the 2 of the most powerful lobbyists in this town for 100 years, the banks and the railroads. It's how we got the financial crisis of 2008 that wiped out workers' savings and permanently set back an entire generation of young Americans. Of course, Wall Street didn't change its ways. Wall Street banks spent the ensuing years lobbying to roll back safeguards we passed in the wake of that crisis. Now, the now defunct Silicon Valley Bank spends hundreds of thousands of dollars pushing for exemptions for banks like this. Their CEO, who came to testify, who now is, I guess, unemployed, sort of, said they shouldn't be subject to strong guardrails because of, quote, the low-risk profile of our activities and business model. Low-risk profile, his words. We know what that really wanted to do, maximize profits, risk be damned. Now look what's happened. The paychecks of thousands of Ohioans, I talked to the leaders of these companies, were at stake last weekend because of these Silicon Valley's executives' arrogance and incompetence. When we let corporations run the economy, workers and their families always pay, whether they're in Cleveland, whether they're in Maryland, whether they're in South Carolina. They always pay, whether it's for the greed of Norfolk Southern or Silicon Valley Bank or Big Pharma or Big Oil. Pretty simple question at stake in everything we do in these jobs. Whose side are you on? Do you stand with corporate lobbyists, or do you stand with communities like East Palestine? Do you stand with Silicon Valley executives and venture capitalists, or do you stand with small business? Do you stand with Wall Street, or do you stand with workers? Same fight over and over and over again. As this committee looks at how to respond to this latest in the long line of financial industry incompetence and greed, I hope my colleagues will put partisanship aside, as Senator Vance and I are doing on rail safety, to stand with the people we serve. Turning to transit, our committee worked on a bipartisan basis to include, as the 3 of you know, the biggest investment in transit ever in the bipartisan infrastructure law. Better transit means new zero emissions and low emission buses. I've talked to the CEO of the Cleveland, the RTA in Cleveland, and she is so on top of that, and it really matters. It means faster, safer service. More people can get to the doctor, to the grocery store, to work, to church. It means more opportunity for all the communities that have been ignored and exploited for too long, whether it's a black community or a brown community, whether it's small towns or rural areas, all the above. I've worked with Senator Rounds a lot. He understands rural transit perhaps better than anybody on the committee, with the work he does with Senator Smith. Both have major rural areas in their upper Midwest states. I'm looking forward to working with Ranking Member Scott on transit issues. Today we have witnesses from both of our home states. We'll hear how the Cleveland RTA is improving their bus and rail service for riders and in replacing decades-old rail cars. The RTA has been planning their investments in new rail cars for years. Because of work we did on the infrastructure law, they're finally going to be able to get better cars and newer, cleaner buses. And Ms. Minor, thank you for nodding as I'm saying that. So Cleveland's also home to the Health Line on Euclid Avenue, one of the best bus rapid transit corridors in the country, and they're joining other transit agencies in Ohio to expand their faster service. I live in the city of Cleveland. I see the kind of service they're giving. Ms. Birdsong Terry is deeply committed to attracting new workers to the transit industry. 2,000 employees she has, so that's a club estimate number, to ensuring these workers have the training they need. I'm also interested to hear how GreenLink will grow in the years ahead to meet the mobility needs of Greenville, South Carolina. Thank you for being here. And we're lucky to have the president of the Amalgamated Transit Unions Baltimore Local, Mr. McMillan, has been an important partner to the committee in making transit safer for riders and workers. Mr. McMillan, thank you for how you honor the dignity of work and fight for your workers. We have an opportunity this Congress to listen to local voices. Senator Scott and I like to do that to learn how to help more Americans enjoy high-quality transit service. We begin that work today. Senator Scott. Today we examine the Fed's actions to combat inflation and whether these actions are actually working, including how those actions affect American jobs and their paychecks. Prices are still too high across many parts of the economy. We know that who feels it the most when the cost of rent and groceries go up? It's not the economic pundits and politicians who lecture us about discipline and stability. It's not the corporate executives who pretend they're making tough choices about prices while reporting record profit increases quarter after quarter and doing more and more stock buybacks. It's the people working hourly jobs to make ends meet. It's seniors on fixed income and Social Security. It's everyone who gets their income from a paycheck each month, not an investment portfolio. It's those same Americans who stand to lose the most if the Fed's actions to curb inflation go too far. No matter what goes wrong in our economy, a global pandemic, a war in Eastern Europe, weather disasters, profits somehow always manage to go up. Workers are left paying the price. As you've noted, Chair Powell, the Fed's tools are only one element in our fight against inflation. It's a complex problem. Interest rates are a single, we know, blunt tool. Raising interest rates can't rebuild our supply chains and fix demand imbalances from the pandemic. Raising interest rates won't end Russia's brutal invasion of Ukraine. Raising interest rates won't prevent avian flu from devastating 1/3 of our egg supply or weather disasters from destroying key crops. And raising interest rates certainly won't stop big corporations from exploiting all of these crises to jack up prices far beyond the increase in their costs. Last year, corporate profits hit a record high. Corporate PR chiefs assure us that these companies just have to raise prices. Their costs are going up. The workers just want to be paid too much. They have no other choice, they tell us. Yet when you look at their profits and their executive salaries and their stock buyback plans, it sure doesn't look like corporations have exhausted every available alternative. It's so brazen. Even global bankers called on the Fed to identify this profiteering is one of the biggest drivers of inflation. Paul Donovan, chief economist of global wealth management at UBS, wrote, "The Fed should make clear that raising profit margins are spurring inflation. Companies have passed higher costs on to consumers, but they've also taken advantage of circumstances to expand profit margins. The broadening of inflation beyond commodity prices is more profit margin expansion than wage cost pressures." Think about that. From a chief economist at UBS, I'll say it again, they've taken advantage, these companies have taken advantage of circumstances to expand profit margins. The broadening of inflation beyond commodity prices is more profit margin expansion than wage cost pressures, unquote. The Fed, understandably, the Fed can't force corporations to change their ways or rewrite the Wall Street business model on its own, but the Fed can talk about it. High interest rates, falling wages, increasing unemployment are all hallmarks of failed policies that end up helping Wall Street, the largest corporations in the country, the wealthiest people in the country. Because let's be clear what we're talking about when people use the economic speak that can cloud this conversation. Cooling the economy means laying off workers. Lowering demand means workers get fewer raises. Of course there are times when the Fed must act. We can't allow inflation to become entrenched. We've seen encouraging trends that isn't happening. And there are other ways we can bring prices down instead of lowering demand. Again, making people poor, laying people off, denying worker raises. We can speed up and strengthen our supply chains. We can bring critical manufacturing back to the U.S. We can rebuild our infrastructure. It's what we're doing with the CHIPS Act, with the Inflation Reduction Act, with the bipartisan infrastructure bill. For the first time in decades, we're finally recognizing the damage that I and many of my colleagues warned the corporate offshoring would do to our economy. Look at East Palestine, Ohio, a community that Senator Vance and I have visited a number of times recently. America learned about this small town last month when a Norfolk Southern train derailed and spewed hazardous material into this community. East Palestine is more than just a disaster headline. Columbiana County was once the center of American ceramics manufacturing, at one time producing 80% of ceramics of dishware in this country. One county produced 80% of it. When I was there last week, I was talking to the sheriff at the 1820 Candle Company. He was talking about how the last one closed just a few years back. Like so many industries, these jobs moved overseas, and we know why. The same reason Norfolk Southern cuts cost at the expense of safety, eliminating one-third of its workforce in the last 10 years. Then you're surprised with these derailments? It's the same reason corporations now keep prices high even as supply chains stabilize. It's the Wall Street business model. Chair Powell knows that. I know that. My Republican colleagues and Democratic colleagues know that. It's a Wall Street business model. Quarter after quarter, corporations are expected to cut costs at any cost. They skimp on safety. They move production overseas to countries where they can pay workers less because of trade deals that they lobbied for. And Wall Street demands they post profit increases, even in the middle of a global pandemic. That's the problem with our economy. And not only will higher interest rates not solve it, if they're overdone, they'll make it worse. We can't risk undermining one of the successes of our current economy. For the first time in decades, workers are finally starting to get a little power in this economy. Unemployment's at a historic low, 3.4%. That's not just a number. That means Americans have more opportunities, more options, even in places that haven't seen a lot in recent years. It means people have the power to demand raises and retirement security and paid sick days and some control over their schedules. It means more Americans have the dignity that comes with a good job that provides for your family. We must here ensure that all Americans have the opportunity for that dignity of work. It's a critical time. The consequences of missteps could be severe. Mr. Chairman, two more things that affect your job. It's not just monetary policy that threatens American pocketbooks. Some of my colleagues have threatened the nation's full faith and credit by holding the debt ceiling hostage for partisan politics. Instead of paying our bills on time, they're essentially threatening all Americans. The Fifth Circuit's Consumer Financial Protection Bureau ruling could also cause unimaginable instability and chaos for families, for consumers, but also, as the chair knows, for a financial system. The Fifth Circuit is Wall Street's, no doubt about it, the Fifth Circuit is Wall Street's favorite courthouse. It recently ruled the CFPB's independent funding is unconstitutional. If the Supreme Court upholds the Fifth Circuit's ruling, it will not only devastate CFPB, it will threaten the independent funding of many other federal agencies, including the Federal Reserve. I look forward to today's hearing how the Fed will balance its dual mandate and continue to promote an economy where everyone who wants a good job can find one, an economy that works for everyone. Ms. Birdsong Terry, what will new bus rapid transit service on West 25th Street do for the neighborhoods along the route, and how is RTA supporting economic development in other neighborhoods around Cleveland, like Slavic Village? My wife and I live about a mile from Slavic Village, so talk about that if you would.
Sure, I would be happy to. Thank you, Chairman Brown. It's amazing the amount of infrastructure that can happen and then the effects that it can provide on a positive note for the residents of Greater Cleveland. We currently have a BRT in place that's been around for about approximately 15 years. So BRT is not new to Cleveland, as you know. However, being able to duplicate that through new projects and with the help of the IIJA is just something that we're really excited about, to be quite honest. There are two particular projects that I want to highlight in response to your question, Chairman. The West 25th Corridor priority project that we have, it's a BRT project in collaboration on the campus of Metro Health. Metro Health is a medical facility that really serves as a level 1 trauma center as well for those type of incidents that we discussed earlier. And it also kind of goes right through the middle of a Latino community along West 25th that really provides an opportunity for accessibility when RTA has service there. Making sure that we can provide opportunity for economics, work, health for those residents of that area is tremendous. We also have opportunity, as you mentioned, through Slavic Village, to be able to serve that corridor. And these are lower income areas that are on the cusp of kind of gentrification in a positive way. Being able to do that really serves the ability to become an economic driver in Cleveland. We're looking at design work for the Metro Health, and with the Slavic Village area, that particular award, we had a $432,000 grant from the same TOD pilot grant program as before. And the goals are very similar between the two projects. We expect to be able to put those into effect within the next coming years. Again, this is just a really great opportunity to show that we have a economic prowess in public transportation, and we're not just simply moving people, we're actually connecting them to opportunities that allow them to be able to contribute to the economic vitality of the region.
Thank you. I would only amend your comments that Metro Health is a public hospital.
Yes.
Equal in quality to more renowned hospitals at University Hospital and Cleveland Clinic. So thank you for mentioning them. I'm happy our committee could authorize funding for rail car replacement. Well, let me back up a second and to ask you about that before the committee. Tell the committee more about the current state of the RTA's rail car fleet. You said they are 38 to 42 years old, something like that, 4 decades old. Talk for a moment about what that means and what replacement will do.
Thank you, Chairman. I'd be happy to. You're correct. Our rail cars, and we have approximately 76 of them, date back approximately 40 years. They vary in range between 38 and 41 years of age. As I mentioned previously, that is well beyond their useful life. And as you well know, we are in the throes of being able to make sure that we can solidify funding to replace all of our rail cars for heavy and light rail. We're actually looking at what I would call a flex car to be able to take advantage of training so that we can actually train up our mechanical staff to make sure that they're at the cutting edge of technology. We're in the beginning stages of negotiation, or I'm sorry, in the middle stages of negotiation for a car builder, and with any luck, we'll be able to announce that publicly this spring. We currently are looking at a $393 million price tag to replace all of those rail cars. So we know that transportation is not cheap by any means. However, it does serve for multiple generations, and that's what we're looking forward to. Just to give you a quick example of the inflation that we have to deal with, just last year, we were looking at a price tag of $300 million. And so that's definitely increased over time. So the longer we wait, the more expensive it will be. And then also with a lot of the rail incidents that have happened within recent times, that is a byproduct of waiting too long. And so we want to make sure that in Greater Cleveland, we're able to take advantage of being proactive. And we have a task team that we have put together for quite some time. And we actually put $10 million aside out of our own budget annually to make sure that we can bridge that gap. We have currently identified $213 million toward that. And our residents are really excited to be able to feel safer on our system. We do everything that we can to make sure that we are providing that type of service. But to be quite honest with you, we hold in more trains than we would like because we have to make sure that they're safe before we put them out. So our ideal situation is a 60-car fleet to be able to be in service and serving our residents within the next 3 years.
Thank you. And I would point out, and thank you for what you're doing on investment, I would point out this committee before I was chair was just referred to as the Senate Banking Committee because it was way too much about Wall Street. Now it's focus in this committee is housing, and this focus in this committee is public transit. And that's why the investment, and I'm hopeful we do even more. So thank you. Mr. McMillan, let me shift to you. And I know I'm over a bit, and Ranking Member Scott can do the same thing.
Please take your time, sir.
Okay. Thank you, Senator Scott. Thanks for alerting the committee about transit agencies, some of their failure to establish their safety committees. We need these committees to function effectively. What more can FTA do to ensure safety committees are functioning? And as you answer the question, tell us what worked well at the MTA in Baltimore as the safety committee was founded, and especially your experience as a driver for more or less close to 2 decades, what new designs for operator compartments make them safer for pedestrians and riders and operators? So bring your personal experience into this answer, if you would.
Okay, yeah. So first of all, it was the ATU who first brought it to the FTA's attention that a lot of agencies that were covered by the unions were not in compliance with the new the IIJA provision. Once they were alerted about it, then it was told by the FTA to our ATU International President, John Costas, that they continue to have the ATU to give them the updates of who's out of compliance. If the FTA could take on that responsibility to be able to ensure that there's a reporting agency within the transportation industries to report back to the FTA about where they are with the IIJA or the Joint Safety Committees, that would be a great help on their part. Also, too, in Baltimore, and once again, I have to give accolades to Senator Chris Van Hollen, because what he did, not only as authorizing the bill, being author of the bill, he continued to have steady communications with the labor leaders in Maryland to ask them, how's it going? Where are you at? And just kept an input on it. Our ATU national president has also had the leadership of from the unions to report back to him so that he could report to the FTA as to where we are. So when I was able to go back to the table, and I'm also a member committee of our Joint Safety Committee, so as soon as I tell the administrator of MTA that, oh, I just had an update with Senator Chris Van Hollen to give him this, they want to make sure that they were in compliance because they did not want to hear a bad report. Also, too, when you were constantly, what we were reminding them of what could be enforced, there's a provision in the IIJA to say that funding should be withheld. Those penalties need to be enforced for those who aren't in compliance. And I think if the FTA would enforce these regulations, it would help better with forming and getting these committees started. From the operator standpoint, being a frontline employee, it's great to hear from the frontline employees. They know what's out there every day. It's not just done by paperwork or analysis that come in through data from just somebody who rides the bus just one day. The commonly occurring assaults, also the bus designs. Our ATU has also created what they call a study on a future bus. This has to do with the A-frames on the bus where there's bad vision sight, also with the mirrors that are put on buses to sort of, it will give better pedestrian protection for those who are crossing the street who may be caught in the blind spots. Also, when the pandemic came along, you had the filtration system. If a person was to cough and the particles get in the air, it would get into the ventilation system. That ventilation system came straight up to the bus operator's compartment. There has been filtration systems that's been recommended on the ATU's behalf to use. Also, closed off compartment when it comes to protecting the operator from not only diseases, but also from assaults. A completely closed off compartment as if you were in a cockpit of an airplane. We also have situations that protect pedestrians. Some of the suggestions that we have given to the administration was if a person can see themselves getting on a bus and they see their face through a camera, it's more likely that they'll think twice before they commit an assault on the operator or harm their fellow passenger on a bus because they know that they can be identified.
Thank you, Mr. McMillan. Thank you, Ms. Hang. And almost every member of this committee will be here today on both sides of the aisle. Make your answers as brief and as quick as you possibly can. So thank you for that. In 2019, by votes of 4-1 and 5-1, now chair of the NEC, Leo Brainerd, the only dissenter in every one of those votes, the Fed rolled back stronger rules and was responsible for supervising Silicon Bank. Mr. Vice Chair Barr, did the Fed drop the ball because it didn't see the risk that was building?
Thank you, Chairman Brown, for that question. Fundamentally, the bank failed because its management failed to appropriately address clear interest rate risk and clear liquidity risk. That interest rate risk and liquidity risk was highlighted by the supervisors of the firm beginning in November of 2021. The board the Federal Reserve Bank brought forward these problems to the bank, and they failed to address them in a timely way. That exposure led the firm to be highly vulnerable to a shock, and that shock came on the evening of Wednesday, March 8th, when it very belatedly attempted to adjust its liquidity position and reported losses on its available-for-sale securities. The market reaction to that was quite negative, and that eventually on Thursday sparked a depositor run.
So some of their practices appear to have violated the basic principles of Banking 101, concentration risk, over-reliance on uninsured deposits, inadequate liquidity, poor risk management, the list goes on. How poorly managed was this bank?
Supervisors had rated the bank at a very low rating. Normally, we would not be describing these matters, confidential matters, but given that the firm failed and triggered a systemic risk determination, I'm prepared to talk about that confidential information. That the firm was rated a 3 in the Camel scale, which is not well managed. And at the holding company level, it was rated deficient, which is also clearly not well managed.
Okay, thank you. Chair Gruenberg, I heard from many small businesses over that weekend who had money in SVB and were worried about making payroll in Ohio, making payroll as a result of the failure. I heard from Ohio small banks and credit unions worried about deposits leaving their institutions. I know that I'm not unique. Many of my colleagues from both sides of the aisle heard those same concerns in their state. Given the unprecedented scale of the bank run, what would have been the impact on small banks and small businesses across the nation if you and other regulators had not taken action to protect depositors at SVB and Signature Bank?
Senator, that was our central concern. I think the evidence suggested from the sequential failures of first Silicon Valley and then Signature that there was a significant risk of contagion to other institutions. And in fact, over that weekend, we were seeing serious stress at other institutions. And I think that and the potential knock-on effects of that contagion is really what led the Federal Reserve Board and the FDIC Board unanimously to recommend to the Treasury Secretary.
So you're saying the actions taken were the least bad option for small businesses and banks across the nation. If you hadn't acted that way, you think there would have been a contagion?
I think there would have been a contagion, and I think would be in a worse situation today with consequences for the actors in our economic system that you referenced.
Regulators, Republicans, Democrats, all across the board, there was agreement on those actions.
Yes.
Undersecretary Lang, do you agree with that?
Senator Brown, I do agree with that. I think the actions that were taken have been working to stabilize deposits. Had they not been taken, the runs by uninsured depositors from many small and regional-sized banks and mid-sized banks would have intensified and caused serious problems for small banks' liquidity and their ability to support small businesses.
Thank you. And if you could answer this really briefly, because I don't want to go over my 5 minutes. Chair Gruenberg, the FDIC announced the sale of SVB and to First Citizens Bank and Trust from Senator Tillis' North Carolina. Estimated would cost the Deposit Insurance Fund approximately $20 billion. How's that cost covered?
Oh, that is required by law, and I indicated in my opening statement. The FDIC has to impose an assessment on the banking industry to cover the cost of a coverage for any uninsured deposits. And I would note that the law provides the FDIC authority in implementing that assessment to consider the types of entities that benefit from any action or assistance provided. And as I also indicated in my statement, we expect to issue a notice of proposed rulemaking for public comment in May to implement the assessment.
Thank you. And I would point out in your testimony and your answer, there are no tax dollars, nothing funded through the congressional appropriations. Intrigued by the Three Forks community, Jefferson River story that you told. What unique challenges, if you'd expand on that, to small, rural, or under-resourced communities face with floodplain management, especially mitigation efforts, what recommendations do you have, if you could be more specific, coming out of that story at the local level for carrying out these initiatives?
Yeah. So I have a great quote from you from the mayor of one of the communities where we work in Glendive, Montana. She said, all these federal agencies, this is Mayor Olson, all these federal agencies agree we have severe flood risk, but we can't afford to fix it ourselves. So this is what we hear very commonly from rural communities. They need assistance with economic solutions to address flood risk. So understanding the feasibility of mitigation options, we can help with technical assistance. Developing revenue strategies, that is something also that communities need help with, even if they're not pursuing grants. If they are pursuing grants, they have local match requirements. If they aren't, they need to locally fund flood mitigation. So again, technical assistance is key, but beyond that, I think we can do a lot to invest in partnerships. Our approach at Headwaters Economics is partnerships between communities, rural and urban partnerships, but also across levels of government. So when the local communities have a problem or want to advance a project, they know who to call at their state, at FEMA, et cetera.
Thank you. David Marstead, Assistant Administrator of FEMA, testified last week in the House that debt interest payments in 2023 were about $1.5 million a day, $600 million. That's not touching, of course, the principal of $20+ billion. You've previously testified the debt is unlikely to be repaid. Do you agree with FEMA that the program's debt must be forgiven?
Thank you, Chairman. I've had the opportunity to testify on behalf of both Republican and Democratic administrations on this topic. What I can tell you is that the debt that exists, the principal cannot be met. I also, 5 years removed from my time at FEMA, understand that you got to find a politically feasible pathway forward. The real issue is the interest. And today, that is, when I was leading the program, $250 million a year in interest servicing. That's gone up to about $500. It's going to keep going. Inside of the next 18 to 24 months, there's likely to be a point by where the average interest rate is 5 or 6%. When I was there, it was 1.5%. It could mean that 33 cents out of every dollar is going to be going to this. So I think Congress needs to find a way to address the interest piece of this. How you want to deal with the budgetary pieces of what is forgiven or not, you got to find a politically viable solution. What they can't afford to do is to pay the interest.
I guess that's a yes, that the program's debt must be forgiven. Is there any other route to go there? I understand the political difficulty of that, which you cite, but...
So I know there have been conversations that I was a part of that says they would set aside and reassign the debt. Frankly, you just can't make it go away. You can reassign it back to Treasury. You could direct that Treasury self-fund the interest side of the equation. I just got into a point that says at the other side, they can't make those payments. I'm with you on that. It likely is going to require a creative Washington-type solution to get to the finish line.
Yeah, well, a Washington-type solution might be put it aside and ignore it, but that's not really a solution, and you know that from your...
7 years into this.
Dr. Kuski in Philadelphia, lots of talk about the free market and the free market taking care of this, and I guess that means the free market would take care of flood maps and mitigation and insurance and cleanup and all the things that Ms. Hernandez mentioned, and that doesn't even seem in the realm of possibility in those who argue for free markets for everything. Let me ask you this, Dr. Kuski. Do you see the private industry taking most of the risk from the NFIP?
Good question. The most recent estimates from the National Association of Insurance Commissioners, which collect data on private flood insurance, are that less than 10% of residential first dollar policies are with the private sector. So the NFIP is insuring over 90% of residential flood. And while advancements in data and modeling have led to this small increase in the private sector, which can be good for consumers with greater options and maybe lower costs, it's unlikely the private sector is ever going to be able to provide coverage for a substantial share of those at risk. We did a detailed assessment of the private market several years ago, and all the stakeholders we talked to found this to be the case, that there are just high-risk areas that the private sector is not going to be able to cover. And in fact, when you look around the country right now, where risks of other climate disasters are increasing, southern Louisiana, Florida, parts of Texas, parts of California, we're seeing insurers pulling back and limiting coverage and raising rates, not leaning into this risk.
Thank you. Thanks, Senator Scott. First question to all three of you, and please just answer yes or no. It's pretty straightforward. Do you agree that individual executives whose mismanagement and disregard for basic banking principles that led to the failure of these banks should face meaningful consequences for their action? Professor Lynn?
Yes.
Mr. Quadman?
Yes, if the information shows that.
Yes.
Professor, thank you. It's clear, and this is for you, Professor Schooner, it's clear that in the case of SVB and Signature, bank executives failed to properly oversee and manage the risk of their institutions. Their compensation was tied to profits, which incentivized them to grow their banks. And the SVB was almost unprecedented in the speed at which it grew. They also rewarded themselves with bonuses in the weeks and months leading up to their failure, even when regulators were raising red flag after red flag after red flag about risks at that bank. Do we need to deter this type of information by individual executives ahead of time so we can avoid a potential failure that put customers, the banking system, and ultimately taxpayers at risk?
Yes, Senator. I think that we need to focus on the ongoing operations of banks in a safe and sound manner, and we shouldn't send the signal to bank executives that when the bank fails, they can walk away and that's it. I think that's the wrong kind of incentive. So we need to encourage prudent operations and management while banks are operating.
Thank you. Professor Lynn, you've found that bank executives are rarely barred from the industry when they've engaged in mismanagement or poor supervision. Why is the existing removal power not suited for the executives of big banks like SVB and Signature?
Thank you, Senator. There are two obstacles. The first is the culpability requirement, which currently is demanding. It requires personal dishonesty or a willful or continuing disregard for the safety and soundness of the institution. And especially in larger banks, the challenge of proving willful complexity increases as to the distance of the wrongdoing. Executives today are shielded from liability because of the diffuse decision-making structure that exists in most large and mid-sized institutions. Second, there is a mismatch between the responsibilities of bank executives and directors, which focus on systemic oversight, putting into place systems, internal controls, structures that promptly detect and efficiently deter operational risks, and the focus of the current authority to prohibit bankers from the industry, which narrowly focuses on discrete activities and whether or not there was knowledge of and participation in discrete wrongdoing. So I have two recommendations. The first is to adjust the culpability requirement, lowering it to perhaps recklessness or negligence. And the second is to identify mismanagement and oversight failure as a discrete basis for removal and prohibition from the industry.
Thank you. Last question, Ms. Schooner. Unlike many other countries that only have a handful of mega banks, the U.S. banking system has thousands of small banks that serve local communities. How would strengthening our enforcement tools to hold bank executives accountable not only help prevent failures, but also improve fairness and competition between large and small banks?
So, Senator, the reality is that most administrative enforcement actions are brought against the managers of failed institutions. And since megabanks don't fail, that means that they escape that kind of accountability. So I think reforming the administrative enforcement power that agencies currently have to better reach the managers of operating institutions would help level that playing field.
And I think all of us were concerned about the GSIBs that seem to get larger and larger, even those that have not performed particularly well. Wells Fargo is always the one that jumps to mind. That all of those banks got bigger with migration of deposits after after SVB and Signature. Deposits were moving to those big banks, including Wells Fargo, to tens and tens of billions of dollars. And then what happened just this week with FDIC choosing, under whatever decision making that was done, choosing J.P. Morgan Chase. Senator Vance from Ohio is recognized.
Great. Thank you, Mr. Chair.
Dr. Bernstein, start with you. For many Ohioans that I hear from, yesterday I was in East Palestine again, for instance, prices for groceries and rents remain far too high. The cost of living raising a family have been rising for decades. Inflation stemming from the pandemic and from Putin's war in Ukraine remains a challenge at home and abroad. While we've seen prices come down in recent months, Americans are searching for more relief. Dr. Bernstein, would you describe briefly how you view inflation at this time, how your views have evolved on this subject over time, and what Congress can do to help the administration tackle this?
Thank you, Senator. As you very correctly suggest, inflation is a global challenge. The rates of inflation are now double in the European Union and the UK than they are here. They're closer to 10%. We're around 5%, and that 5% is down from its most recent peak of over 9% last June. The fact that inflation has been global, despite different policy agendas across different countries, provides an important reminder that its overriding cause was, as you suggest, first the pandemic and then later the war. That is, countries all had different fiscal and monetary responses, but they all had fast rising inflation. And while we still have ground to make up, as noted, our inflation's fallen much faster than either in the EU or the UK. Now, inflation is a function of strong demand, especially for goods, it was during the pandemic, as well as damaged supply chains. In answer to your question of actions that we've taken, one of the first things we did out of the box was to try to repair damaged supply chains, improve the logistics therein, and increase the flow of goods across the globe. That work has been quite successful. Supply chains are much repaired from where they started, and in fact, core goods prices have been negative or about zero for the last 6 months. Finally, fiscal and monetary policy since 2020 contributed to demand, but it also helped us to get to the other side of the crisis. The rescue plan in particular got shots in arms, checks in pockets, setting up an historic recovery with a labor market that, as you said in your opening statement, has made some remarkable gains. Hundreds of millions of people received vaccination, child poverty cut by half, the first national eviction prevention program, small businesses getting to the other side of this recovery and posting record entrepreneurial gains in this period, and of course, a real GDP level that's 5% above its pre-pandemic level and well above that of the G7. So I think that balanced view hopefully covers both our understanding of inflation, actions we've taken to ameliorate its pressures, as well as some of the very positive, important growth effects that everyday people are benefiting from.
Thank you for that answer. Mr. Green, prior to your hearing in 2021, you wrote the committee. You unequivocally stated you do not support defunding the police. You testified in 2021 under oath that you do not support defending the police. Put this issue to bed once and for all. Again, under oath, do you support defunding the police?
I do not support defunding the police, Chairman Brown.
Have you ever advocated for, do you support defunding DOJ, the FBI, or federal law enforcement?
No, I have not.
Okay, thank you for that answer. Talk about defunding the police today is a distraction. My colleagues know that. The chart that the ranking member held up, we're not your words understanding that. The witnesses have stayed under oath that this witness does not support defunding the police. But what's ironic on this is these political attacks endure in presidential races and Senate races, wherever. What's interesting is that it's Democrats who funded the police. The American Rescue Plan enabled communities around the country to keep cops on the job through the pandemic. Democrats voted for the American Rescue Plan. Republicans, to the person, opposed funding local and state police in our communities. Republican politicians today in the House and Senate are actually calling for defunding law enforcement, defunding the FBI, defunding DOJ. Prominent Republican politicians continue to do that while accusing Democrats of something that Democrats simply haven't advocated for. If you care about law enforcement, you support them in word and deed, period. Now, my last question for Mr. Bordzkowski. You have significant experience leading and managing economic research organizations. Briefly describe how your experience has prepared you for this role and how you approach evaluating risk to our financial system.
Thank you for the question, Chairman Brown. I think, given that time, I'll do this very briefly, but
My role at the CFPB in particular was to build a research office for a brand new government agency, and that meant gathering the data resources, hiring the personnel that were necessary, putting in the correct policies, procedures, and safeguards for those data, all to make sure that we could do the analysis, provide those at the time to Director Cordray and later to Acting Director Mulvaney and Director Kraninger, so that they can make the policy decisions the Bureau needed. And that was primarily my role over that period.
Remember also, Mr. Becker, SVB experienced astounding growth from 2019 to 2021. Assets grew 198%, 6 times the median growth for comparable banks. When SVB was growing fast, did it ever occur to you that new deposits funding that rapid growth could leave the bank as quickly as they came in?
Senator, when the growth was occurring, I think it's important to note that the growth was from existing clients. So yes, we added new clients, but it was mainly our existing clients were raising more substantial amounts of money. And so we built several things. One is we added to our liquidity, making sure that we had borrowing capacity so that we could support an outflow of deposits which would occur. But again, I think it's important to note that was mainly from existing clients.
By every measure, that kind of growth may sound good to Wall Street, but for most bank managers, it means more risk factors to keep track of. When your bank failed, it had 31 unresolved matters requiring attention, the Fed's term, 31 huge red flags identified by regulators. I think it's safe to say rapid growth was not because Silicon Valley Bank was 6 times better than other banks. Mr. Howell, once you started new business lines, it was important to show investors that Signature Bank could still be profitable. Is that right?
Profitability was certainly something that we always looked at.
It seems like big losses and a struggling stock price motivated management to jumpstart profits and boost the stock price. In doing so, you just didn't seem to care about increasing obvious risks. Mr. Becker, your version of events blames SVB's failure on too many interest rate hikes, a social media-driven bank run, the closure of the much smaller Silvergate Bank, and the regulators for being slow to highlight its long-standing problems. It sounds a lot like the dog ate my homework. Your explanations ignore that your bank was without a chief compliant officer for the better part of a year. I don't think that was in your testimony. While you watched deposits leave and losses on long-term investment securities began to pile up, your version on that leaves out that you only tried to fix things when you were told that SVB was going to be downgraded. Is there any other explanation that you just wouldn't make any effort to fix the growing problems because it would have cut into earnings?
Chair Brown, we took risk management seriously, and we both were proactive in risk management and also were responsive to the regulatory feedback. And I think in the GAO report, it outlined the responsiveness that we had. And I think if you have an opportunity to talk to regulators that were directly involved, I think they would share that point of view. Regarding the chief risk officer, if I may add to that answer, we decided, the board and I, along with feedback from the regulators, that we were going to look for even more experienced CRO. And in my experience, it takes 6 to 9 months to find the best person for a role. We did 2 things to make sure that we had coverage while we were looking for a chief risk officer. First, we created an office of the CRO with the leadership team reporting to me and reporting to the chair of our risk committee. And secondly, we kept our chief risk officer on board as a consultant through October 1 to make sure there were no gaps during that period of time.
Mr. Shea, one of Signature Bank's fatal flaws was a concentrated depositor base that made it susceptible to a bank run. FDIC and New York banking regulators identified this as a problem. Signature Bank management assured them the bank's relationships and dedicated customer service would make customers less likely to flee. In the end, you bet on the hope that customers really valued that relationship, ignoring common sense risk management. The bank ended up with an extraordinary level of client concentration. The numbers, frankly, are hard to believe. 60 clients held 40% of total deposits, 4 depositors accounting for 14% of total deposits. Did you need that kind of concentration to make quick profits, Mr. Shea?
The bank took steps to
offset and ameliorate the concentration of uninsured depositors. The bank set aside an internal allocation of liquidity in order to offset or in order to provide an internal collateral measure of maintaining high-quality assets against uninsured deposits. In addition, the bank endeavored to diversify its deposit portfolio mix and maintain liquidity availability to offset those higher concentrations of assets.
Thank you, Senator Scott.
Thank you, Mr. Chairman.
Senate Committee on Banking, Housing, and Urban Affairs will come to order. We have a quorum present, so we'll enter into executive session to conduct committee business. Today we'll mark up two pieces of bipartisan legislation. S-1271, the Fend-Off Fentanyl Act, an original bill offered by Ranking Member Scott and me, the Recovering Executive Compensation Obtained from Unaccountable Practices, the Recoup Act. These bipartisan bills we'll consider today will make our communities safer by helping stop the flow of dangerous fentanyl into our neighborhoods, and will make our economy fairer by holding bank executives accountable for their failures. Both bills are collaborations. Ranking Member Scott and I have taken feedback and ideas from members on and off this committee. We talk, we listen, we negotiate in good faith with each other on both bills. I particularly thank his staff and my extraordinary staff, not that his isn't extraordinary too, but I know mine better, for their work together. I want to thank all of our members. Literally every one of the members of this committee was involved. Committees come together to address one of the most significant crises of our time, the flood of dangerous illicit fentanyl that is taking thousands of lives and devastating communities in Ohio and South Carolina and around the country. Senator Scott and I listened to law enforcement and community leaders. We listened to advocates for Americans struggling with addiction. We worked together to introduce the Fend-Off Fentanyl Act. We've nearly every member of our committee and more than half of all senators as co-sponsors. We're on the cusp of 60 co-sponsors, half at each party. We have a broad outside coalition pushing for this bill, everyone from the American Association for the Treatment of Opioid Dependence to the National Sheriff's Association to the Fraternal Order of Police. It's an issue that hits home for each of us. In 2021, fentanyl was involved in 80% of Ohio's unintentional drug overdose deaths. I hold roundtables all over the state, and I know my colleagues do too in their states. I hear over and over from Ohioans from all walks of life that we need new, more powerful tools to prevent the flow of this awful, increasingly more potent drug into our communities. It's why our bill uses our economic arsenal to target the foreign fentanyl supply chain, from the Chinese chemical suppliers to the Mexican cartel distributors to the money launderers profiting off the illicit drug trade. I want to thank my colleagues for joining this bill and look forward to continuing working with all of you to get this signed into law. We'll also consider the Recoup Act. This bill is part of the committee's response to the historic bank failures earlier this spring. Throughout the spring, we held hearings bringing before the committee the executives of these failed banks, the bank regulators, and experts on bank accountability. Republicans and Democrats alike agreed these executives failed at the basics of bank management, that they pushed an unsustainable business model because it increased short-term profits and their own compensation, that they ignored directives and warnings from regulators, that they took risky bets at the expense of their customers. They paid themselves bonuses right up until the moment the FDIC was forced to step in. American workers and their families should not be forced to pay the price for executives' risky bets that don't pay off, whether they're on Wall Street or whether they're in Silicon Valley. To most Americans, the lack of Wall Street accountability tracks with their entire experience with our economy. Workers face the consequences for bad decisions made in corporate headquarters. We know that. Executives who made these decisions too often ride off into the sunset with their bonuses and their stock options in tow. Americans will never forget that, by and large, the Wall Street executives who caused the 2008 financial crisis faced few consequences. Their profits, their bonuses were not clawed back. We will not let that happen again. Our bill with Senator Scott ensures that bank executives will face real accountability for gambling with customers' money. The bill does several key things. It will strengthen regulators' ability to ban or remove executives who fail to appropriately oversee and manage their banks. It will provide the FDIC authority to claw back compensation of failed bank executives, senior executives. It will increase and strengthen penalties against bad actors. It will require banks to adopt corporate governance and accountability standards that promote responsible management. Bank executives who take on too much risk and crash their banks shouldn't get to land on their feet. They shouldn't get to keep the profits they made by making bad bets with other people's money. They shouldn't get to take their bad behavior to another bank. I want to thank the members on and off this committee who introduced different bipartisan bills to address this problem. I thank Senator Warren and her co-sponsors. I thank Senator Reid and his co-sponsors. With bipartisan support on each bill, their work helped generate ideas, build momentum for action, and advance these efforts. I want to thank Senator Scott and his staff for working with my staff and me. We have bipartisan agreement on a comprehensive bill that cracks down on irresponsible executives who poorly manage their banks, who put customers and workers and the entire economy at risk. That tells me the ranking member and I have threaded the needle pretty well. So thank you, and with your performance and that job, it will be many more times because I think the American public likes hearing about the progress that CFPB has made. Thank you. 2010, Congress charged the CFPB with enforcing our mortgage laws so that families would never again face the types of predatory loans and practices that devastated so many communities, destroyed so many people's financial lives in 2018, and did immense damage to the economy as a whole. What would it mean for homeowners in the mortgage market if CFPB didn't have a strong independent structure as Congress intended?
Well, certainly, in as much that the Fifth Circuit's ruling is sustained, it will create major uncertainty in our mortgage markets. It will be difficult to lenders to know what the rules of the road are, and borrowers may not have the clear responsibilities and rights to safeguard them. We learned a hard lesson in the financial crisis when it came to predatory mortgage lending, and the reforms that we put into place have built a lot of resilience in the system.
Thank you. That's why, as you know, I led 35 of my Senate colleagues in filing an amicus brief defending the CFPB's constitutionality, fighting so that CFPB continue to create a fair, transparent, and competitive mortgage market, how important that is, protect consumers' biggest financial asset and the key to intergenerational wealth. In 2008, we saw what happens to homeowners. You've said that a number of times in the broader economy when we don't have a strong consumer protection agency. We can't let that happen again, so thank you. Let me talk about medical debt for a moment, Director. 41% of U.S. adults have medical debt. It's clear that accidents and sickness can happen to anyone, young or old, at any time, yet medical debt can affect a person's ability to rent or buy a home. People with medical debt are hounded to pay and are often made to feel like a burden to society. To alleviate the burden of medical debt, Director, would CFPB consider rulemaking to remove all credit debt from credit reports and eliminate deferred interest on medical credit cards?
Well, let me just say that so many people in our country are pushed to pay medical bills that they may not even owe. Many of them have already paid it or are stuck in the loop between the insurance company and their provider, often getting duplicative or conflicting bills. And the concern that the CFPB has is that the credit report may be used as a tool to coerce people into paying something they do not owe. So we are looking at all aspects of the Fair Credit Reporting Act to see whether it is appropriate for credit reports to be used in that way, and we are considering options to restrict some of the parking on credit reports that may be false or inaccurate, because the consequences for individuals are very real. They may fail a background check because of it, even just because they were sick or they had an inaccurate report on their credit report.
Okay, thank you. In November, I wrote to you about the growing number of homeowners suddenly facing threats of foreclosures for second mortgages they didn't even know they had, that they owed. They call them zombie foreclosures. Many of these homeowners haven't heard from their lender in years. Just last week, we found out that some of the companies trying to collect on these debts are actually private equity firms that have targeted single-family homes as a big moneymaker, buying up homes, jacking up rents. Now they're trying to foreclose on homes based on old mortgages. What are you doing to protect consumers from these predatory zombie foreclosures?
Well, so many people got piggyback mortgages. These were 80-20 mortgages where there was a second. Many of them modified it and had not heard and believed that it was satisfied and received representations that they were satisfied. We're now seeing some of those old second mortgages come back, and people are getting across the country foreclosure threats, even though they had already satisfied that. We have issued some guidance to make clear about what the current law expects when it comes to time-barred debt or zombie debt, and we will look to take actions where there's violations of law. This is the type of thing that can really undermine mortgage markets, and we need to make sure it is fair and transparent across the board.
Thank you. Last question. Sunday Magazine, New York Times cover story published a lengthy article just last Sunday describing how consumers desperate to improve their credit scores end up spending billions of dollars on questionable credit repair services. What's the CFPB doing to protect consumers from some of these, from shady credit report outfits that charge consumers big bucks but fail to deliver lasting results?
Well, so much of people's lives are determined by that 3-digit score, that credit score, and people will go to great lengths to fix it. We have taken a number of enforcement actions against outfits that have illegally taken fees and run off, but we need to look more holistically at the credit reporting system so people know how they can fix errors and not be subjected to scam artists.
Thank you. Paul Donovan at UBS has discussed the role that corporate profiteering plays in persistent inflation. While inflation has fallen from 9%, as you know, it has peaked to 4%, prices continue to climb because of supply shortages and corporate profiteering, what we're starting to call greedflation. Given that rising interest rates certainly won't solve greedflation, why maintain interest rates at the current level or even consider, as you suggested, raising them again, given the risk of harming the livelihoods of more than 1.5 million workers and their families?
Mr. Chairman, the committee broadly feels that while monetary policy has gotten to an appropriately restrictive level, if the economy performs about as expected, that it will be appropriate to raise hikes again this year and perhaps twice. A strong majority of the committee feels that it will be appropriate again, assuming that the economy performs as expected 2 times before the end of this year. We've come very far, and the reason why we maintained our rate at the last meeting was to give ourselves more time to stretch out the time for making these decisions. We moved very quickly at the beginning, and we've gradually slowed down. This is just a continuation of that. But we are committed to getting inflation under control, and the strong majority of the committee feels that we're close, but there's a little further to go with rate hikes.
Well, thank you for that answer, but Mr. Chair, what Fed governors call cooling down, regular people where I live call them layoffs. The question is, why should working families continue to bear the cost of fighting inflation? Why should they lose their jobs so that corporate profits can continue to balloon? Let me move to the next question. Our economy's created 13 million new jobs in the last 2.5 years. Black and Latino workers with the lowest incomes have seen the greatest gains in job opportunity and wage growth. What the Fed considers too hot an economy has given these workers their first leg up in decades, if ever. We know that job losses will hurt those same workers the most. How will higher interest rates and the resulting job losses disproportionately impact Black and Latino and low-income workers?
Well, we have quite an unusual situation in the labor market where we've had persistently much higher demand for workers than the available supply of workers. So some of the process of getting demand and supply back into alignment has been taking place through declining job openings and through lower quits rates and through wages that are moving, that are still very high, but moving into more sustainable levels of increase. So actually there hasn't been a meaningful increase in unemployment. The unemployment rate has bounced around at historically low levels, and that's fine. That would be the perfect way for this to continue to happen. There's no guarantee that will happen. I would just say that it is working families who suffer most directly and quickly from high inflation, and it is for the benefit of those people and all other people that we need to restore 2% inflation in this country on a sustained basis.
And thank you. But in the dual mandate suggests that those workers, that obviously you look out for those jobs and those workers, but we also know that those workers are the first to be laid off. And I would hope that in your next meeting, the Fed recognizes those disparities and gives them real weight as you make decisions that will likely at some point result in more layoffs. Probably my last question. Since you last testified in front of this committee, we've had 3 of the largest bank failures in U.S. history. You explored that a bit at the end of your testimony because the executives at those banks failed at Banking 101. Regulators took swift and decisive actions to protect the banking system and depositors. Thank you for that. That's in stark contrast to regulators' supervisory failures in the years before the 2008 financial crisis. What actions are you taking today to prevent more bank failures and to make sure banks do real risk management and address liquidity and other basic risks? And you may in part want to answer, I mean, he can do it himself, but Ranking Member Scott's comments on Vice Chair Barr and where that takes us. But what do you do to make sure banks do real risk management and address liquidity and other basic risks?
So I would say we are committed, and I am personally committed to learning the right lessons from what happened in Silicon Valley Bank and the other 2 failures and vigorously implementing appropriately. I think there's a clear need to strengthen both supervision and regulation of banks of that size. And I can go into more specifics in the course of the hearing, but I do think we need to learn those lessons, and I think we've started to do that. And it's something, what we saw was an unexpected bank failure overnight led to contagion and threatened the broader banking system, and that's not supposed to happen. And we're gonna take appropriate measures to reduce the chances that something like that would happen.
Let me follow up briefly on that. The Fed plans to propose an overhauls we've talked about to existing bank capital requirements, so we have a more resilient banking sector. Is increasing capital requirements for banks with $100 billion or more in assets to prevent future bank failures, is that a strategy the Fed plans to, is willing to deploy to promote financial stability?
So we have not come to there hasn't been a final proposal. There's been a draft proposal that's been circulated, but it's, in my understanding, it's not final, and I know things are still moving around a little bit. So I don't really have a final proposal that I can comment on. I do think that the capital increases that are getting so much notice are really on the larger banks. There may be also some capital increases in the proposal for banks down to $100 billion, but not below that.
And yesterday you said we want to, in particular the G-SIBs, the 8 largest banks, to have very high levels of capital and liquidity. You stand by that statement?
I did, and I said, of course, we did spend years raising capital and liquidity standards a great deal on those institutions, and I supported all of that. And then I concluded by saying that further increases, if they are proposed, will need to be justified. They'll, of course, as any change in rule would be.
Senator Scott.
Chairman, let's stay.
The Committee on Banking, Housing, and Urban Affairs will come to order. Thank you all for joining us. Senator Scott, thank you for your work. All of our work on safeguards for our banking system must come back to one goal: protecting Americans' hard-earned money in the bank, protecting American taxpayers. Because working people have been forced to pay for big bankers' bad decisions over and over. In the wake of 3 of the nation's largest bank failures in history, 3 of the largest in history, this committee held a series of hearings with failed bank executives, the bank regulators, and outside experts. It's our job to hold accountable everyone responsible for the gross mismanagement and risk-taking behavior of these bank executives that threatened the stability of our banking system. Out of that effort, this committee came together. Senator Scott and I worked hand in hand on this to advance a bipartisan bill that will hold bank executives accountable for their misconduct to help prevent future bank failures while protect consumers and taxpayers. The Recoup Act, the bill we passed 21-2 out of this committee, will ensure that executives who follow the Wall Street profit at all costs business model will not be able to cash out when their bad decisions threaten middle and working class families' financial security. The Recoup Act is an important and necessary step to prevent bank failures. This committee will work to get it passed into law. The collapse of the Silicon Valley Bank, of Signature Bank, of First Republic Bank illustrates why we need important guardrails on executives, on the way big banks operate. We need better protections, stronger capital liability standards, for instance, tougher stress tests, and more rigorous enforcement and supervision. The bank failures also raise questions about our federal deposit insurance system. That's what our hearing's about today. SVB and Signature ignored liquidity risk. They used overwhelmingly uninsured deposits, all concentrated in the same industry, to finance unsustainable growth. More than 90% of deposits at SVB and Signature were uninsured, more than 90%. That's about twice the average at Ohio's regional banks and far more than that at community banks. And when those bets don't pay off, venture capitalists triggered a social media-fueled bank run, a panic that led to consumers yanking $42 billion out of SVB in less than a day. Signature Bank lost $18 billion. When these banks failed, small businesses whose accounts were at SVB and Signature Bank from Ohio to Utah and across the country just wanted to make payroll. Ohio banks and credit unions didn't want to see their deposits flee to Wall Street mega banks. Regulators, both Republicans and Democrats, came together to prevent the panic from spreading, protecting consumer and small business deposits without taxpayer money. The recent failures were not the first time we've covered the losses of uninsured depositors. We used the systemic risk exception and temporarily expanded deposit insurance in the past, including during emergencies like COVID and the financial crisis of 15 years ago. We understand the need to protect depositors, promote confidence and stability in the banking system in a time of crisis. But it's also our job to make sure banking safeguards work for everyone, for consumers, for small businesses, for banks that serve their local communities, not Wall Street mega banks and big investors. Deposits serve a critical function in our basic banking system. They are the source of our money supply, the financing that banks use to make loans to middle and working class Americans looking to buy a home or start a business. Community banks play a pivotal role in making these loans. They maintain close ties with their communities. They have a vested interest in the customers whom they see and whom they serve every day. People know these bankers and trust them to use their deposits to invest in their local communities and make loans to their neighbors. Yet decades of consolidation and concentration have led to deposit flights to the Wall Street mega banks, stripping wealth from local economies. And over the past 20 years, the number of commercial banks has been cut in half. Today, only 14% of deposits are held by community banks. If customers move their deposits to mega banks because they think they're the only place the deposits are safe, has an outsized impact on investment in local communities, the local economies and communities, especially in rural communities where often community banks are the only commercial bank presence. And when regulators take action to protect uninsured depositors and prevent a crisis from spiraling out of control, those costs, like the special assessment to pay for the failures of SVB and Signature, should be borne by the banks that take on the most risk, yet somehow still benefit the most. We can't let Wall Street mega banks siphon deposits from smaller banks, then scoop up failed bank assets at a discount, then continue to grow unchecked. When we, 90 years ago, created deposit insurance, we promised Americans that reckless gambling on Wall Street wouldn't put Americans' hard-earned dollars at risk. Since then, every time a bank has failed, FDIC's made sure that uninsured depositors didn't lose a penny, and working American families have the confidence to keep their money in banks without fear of a bank run. The purpose of today's hearing is to understand whether our current FDIC framework continues to fulfill that promise. Our panelists come from diverse backgrounds. I thank the three of them for joining us and present unique perspectives on what changes, if any, should be made. We need to make sure deposit insurance protects small savers, workers, and businesses, and promotes competition, confidence, and stability to work in the banking system, in community banks and credit unions and regional banks, not just the big investors and the big mega banks. We also need to make sure that the rules banks have to follow to prevent bank failures are strong enough too. Because, make no mistake, increasing deposit insurance coverage without putting in place stronger guardrails is akin to throwing a lit match onto a pile of dried leaves. Changing deposit insurance is not a cure-all, to be sure. It's a complement to stronger financial regulations and banking supervision, sending a signal that the financial industry can make risky bets with abandon, and if their banks fail, the government will always pick up the tab, will only lead to more failures, more financial crises. We've seen what happens when big banks don't properly manage risk and build up sufficient capital. Too often, it's always workers who face the consequence. Every time Wall Street crashes our economy, we put tougher guardrails in place, protect workers and consumers and preventing from happening again, as we should. But then lobbyists go to work, watering down, sometimes erasing altogether important financial safeguards. We can't make changes without first undoing the rollbacks of financial safeguards that have reduced bank supervisors' ability to police unsafe practices and to ensure the biggest banks have sufficient capital and liquidity. Our financial watchdogs must work to strengthen our system, help our economy grow, support local communities, ensure working families and small businesses' money is safe. Senator Scott.
May have.
Thank you, Mr. Holman. Appreciate your being here. Ms. DeVito, start with you. Senator Scott said, and factual, no depositors ever lost a penny on uninsured deposits in 9 decades, but we've seen several systemic risk events during the 2008 financial crisis and the recent bank failures. The failure of First Republic resulted in increased concentration at the biggest bank in the country, way above the 10% cap, perhaps. What did these events, Ms. DeVito, reveal about the strengths and weaknesses of our banking system and deposit insurance framework? How do other bank regulatory policies help protect depositors and financial stability?
Thank you, Senator. So the crisis this past spring suggests that there are at least, I think, 3 underlying vulnerabilities in our banking and deposit insurance systems. The first is that it revealed depositors are incredibly flighty under the current deposit insurance terms, and that these depositors can threaten financial stability. The second, I think, is that it casts doubt on how effective depositor discipline is right now. We saw with SVB that even large depositors don't currently seem incentivized to or capable of policing banks the way we would need them to maintain financial stability in the long term. And third is that it does seem to be exacerbating rising bank industry concentration through both mergers, as Mr. Frazier mentioned, and deposit flight. If uninsured depositors at smaller banks feel they need to go to larger banks to get that sense of perceived safety, that can exacerbate bank industry concentration as well. In a vacuum, as deposit insurance expands, it removes incentives for depositors to monitor banks. But depositor discipline is only one input into overall market discipline for banks. So bank regulation and supervision play a really strong role in ensuring that banks are operating safely and soundly.
Thank you, Mr. Frazier. When people put their money in a bank, we want it to be reinvested in the community. We want it, obviously, most importantly, to be safe. Talk about why deposit insurance is important to consumers and small businesses, also how it's critical to the role of community banks like yours.
Thank you, Senator, for the question. And deposit insurance is part of a backbone of what I call the banking contract that we have, and it requires banks to operate in a safe and sound manner, to protect consumers and small businesses especially, and to facilitate and provide access to credit. So deposit insurance enables that, along with access to other liquidity sources and such. To the extent that consumers can rely on that and they understand that, then banks have that obligation to perform those 3 activities I talked about. I am growing increasingly concerned, however, about the rise of bank-like services that have the attributes and look and act and talk like a bank and create consumer confusion. And in particular, about 45% of the accounts opened just this year alone are in these bank-like entities, and I'm worried about where that boundary line is.
Thank you. Back to you, Ms. DeVito. Over the weekend, the SVB failed. I talked to many small Ohio businesses who were worried about their ability to make payroll. What are the benefits of expanding deposit insurance coverage for all demand deposits, and what are the downsides that we need to account for and other policies that might mitigate those concerns?
One of the most important benefits to expanding deposit insurance is that it would reduce the likelihood that depositors panic, and so reduces the risk of bank runs. If deposit insurance were to be expanded, for instance, to all non-interest-bearing accounts, which represent accounts that people use to keep their money safe and accessible rather than as a source of investment, then any depositor with balances over the cap would benefit. Minimizing the number of depositors who could initiate a bank run would enhance financial stability objectives as well. Some of the downsides include that as deposit insurance expands, you could increase moral hazard. This effect, though, could be offset through other mechanisms such as tightening banking regulations and supervision, revisiting capital requirements and liquidity regulations in particular. And then coming to consensus on eligibility is a challenge. We need to make sure that whatever terms to FDI reform occur are enforceable through the FDIC and verifiable and communicable by banks to customers and by the FDIC to banks.
Thanks. Last question, Mr. Fraser. Uninsured deposits have been trending upwards since the 2008 financial crisis, as you know. We've seen more migration to non-banks, as you point out in answer to the last question, and shadow banks that are not insured or regulated like traditional banks. What risk does this pose to consumers, banks, and the whole financial stability of our system?
Right. It comes down to where expectations begin to evolve about what is insured and what's not insured, and what can happen when deposits migrate outside of what I call the regulatory perimeter, that is to outside of where there's oversight, where a regulator, a prudential regulator can monitor those activities related to consumer protection and safety and soundness. There's a risk for customers to suffer adverse behavior or things in that regard. But more importantly, it poses risks outside of the system so that if a non-bank entity were to fail, a payment processor or someone were to fail, what are we going to do as policymakers to solve that problem? And I think as we think about deposit insurance reform, the lines need to be bright and clear as to what's inside the perimeter and what's outside of the perimeter. And I could tell you a quick anecdote about that, but maybe I'll do it separately, where we had a customer of ours go to a payment type system and said, I'm not worried about it because I expect if something goes wrong, someone will bail us out and help. So that expectation's evolving, and I think we just got to have a bright line as to what's in and what's out.
Thank you. Senator Scott. For the economy to truly deliver security and opportunity for American workers, we need plentiful job opportunities, we need high wages, we need low prices. Prices are the current problem, but it's been decades since workers have had all three at once. No matter what goes wrong in the economy, whether it's a financial crisis or bank failures, whether it's supply chain turmoil or energy market disruption, working people always pay the price. Meanwhile, corporations always somehow find a way to increase their profits. They always find a way. Financial crisis, profits go up. Mass unemployment, profits go up. Global pandemic, profits go up. War in Europe, profits go up. Increasing energy costs, profits go up. When supply chains ground to a halt when Putin invaded Ukraine and the economy reopened and demand surged everywhere all at once, the rest of us saw problems to solve. But in many corporate boardrooms, executives instead saw an opportunity. For the largest multinational corporations, inflation has been a perfect excuse to increase profits by raising prices far beyond the costs of their inputs. The main tool that many in this town look toward to rescue us from inflation, hiking interest rates, can do little to solve that problem. It's little wonder then that when American workers see the high prices at the grocery store, at the pharmacy counter, at the gas pump, along with rising borrowing costs for mortgages and credit cards and car loans, they remain skeptical of government and its willingness to address the challenges people face. Inflation, of course, is a complex problem. The Fed's been fighting it with a blunt tool, and we made progress. Inflation is at the lowest level in the last 2 years, giving hope that the price of consumer goods will continue to decline. And despite the experts' prediction, job growth remains strong. The country added 339,000 new jobs in May. Ohio's unemployment rate, 3.6%, is the state's lowest in 20 years. Unemployment for Black and brown Americans remains near historic lows. Think about what actually means for workers in Alabama and Ohio and North Dakota and Louisiana and Minnesota and South Carolina. What that actually means for workers all over the country. It means Americans have more opportunity and choice in their lives, even in places they haven't seen a lot of options in recent years. It means people have the power to demand raises and retirement security and paid sick days and control over their schedules. It means more Americans have the dignity of work that comes with a good job that can provide for your family. And look where that kind of power for workers is taking us. Last month, wage growth outpaced inflation. That's the way it should be. Today's hearing comes at a critical time. Last week, the Fed decided to pause interest rate hikes after 10 consecutive increases and to maintain the rate at its current level. For the many of us who are concerned that further rate hikes could do more harm than good, it's welcome news. The challenge you face, Chair Powell, is to ensure that workers continue to see higher wages while also continuing to rein in inflation. In previous hearings, you've noted with justifiable pride how careful management of the economy helped millions of workers return to the job market. It's those workers who stand to lose the most if the Fed overdoes its rate hikes, loses sight of the dual mandate, and drives the unemployment rate back up. As you've also noted, Mr. Chair, increasing interest rates is not the only tool we have to fight inflation. The Fed is not the only one with a role to play. Congress, the administration, everyone in government, and corporate boardrooms must do their part. There's no reason we can't continue coming together to bring prices down. More policymakers are finally recognizing what those of us in Ohio have known for years, that outsourcing the production of pretty much everything may mean higher profits in the short term, but it won't lead to a resilient economy with a strong middle class in the long term. We've taken steps to strengthen our supply chains in hiring and bringing critical manufacturing back to the U.S., the CHIPS Act, the bipartisan infrastructure law, a number of things. We must continue that progress instead of lowering demand, which is just economics textbook jargon for making people poorer, laying off workers, denying raises. Instead of lowering demand, we can produce more, we can build more, we can grow the economy from the middle out. It's also our first semi-annual report from the Fed since the string of bank failures this spring. Those failures were caused by the same issue at the heart of so many of our economic problems. It's the Wall Street business model. Executives lay off workers. They put short-term increases in quarterly profits and their own compensation above everything and everyone else. At Silicon Valley Bank and Signature Bank, those in charge pushed their banks to grow too big, too fast. They made risky bets. They got massive profits. Executives were paying themselves bonuses right up until the moment that at least one of these banks crashed. To most Americans, that's not surprising. People have gotten all too used to big bankers treating the industry more like a game, or maybe more precisely, an endless ATM for themselves, secure in the knowledge they won't pay any real price if things go wrong. Mr. Chairman, as Senator Scott and I teamed up on a 21-2 vote yesterday, those days for bank executives are over. Chair Powell, I look forward to hearing today how the Fed will protect American workers in the fight against inflation and promote an economy with a strong, growing middle class. Senator Scott.
Thank you.
Mr. Heller, you can't open a newspaper without seeing stories of homeowners facing skyrocketing insurance rates with less coverage, higher deductibles, not being able to find an insurer despite what some say. It's not happening, of course, only in California. Why are so many people across the country, answer this as short as you can, why are so many people across the country suddenly being priced out of the homeowners insurance market?
Well, thank you, Senator Brown. The first reason, there are a few reasons, but the first reason, we have to acknowledge it up front, is that climate change is severely exacerbating the cost of risk transfer because it is increasing the severity and frequency of disasters. You mentioned an example, 15 $1 billion events this year alone. The Swiss Re actually reported that the most severe incidents were in Texas. We talked about California, Florida. This is happening around the country. Climate change, as you said, is a national concern, and it's affecting insurance markets everywhere. The unregulated global reinsurance market is number 2, is a driver here. These drastically increased premiums over the past 2 years actually put the Rate Online Index produced by Marsh McLennan's Guy Carpenter subsidiary at the highest in the history of the index, which has been calculated since 1990. So that risk transfer is also too expensive. There has been inadequate oversight of state insurance markets around the country and some terrible rules that require some of the big state public insurers of last resort, the Citizens in Florida and Louisiana, to actually charge customers more than the actuarially indicated rate. That makes no sense. Why are we making last resort insurers charge more than they need to charge to provide coverage? And then finally, I mentioned there is the specific pain point for lower income Americans who, because they don't have great credit, find themselves seeing 40, 60, 80% premium spikes just because of that, even without claims. So it's a confluence of these incredibly difficult issues.
Thank you, Mr. I hope we can get agreement, at least acknowledgement from everybody on this committee of both parties of the existence of climate change and the severity and the huge cost in so many ways to all of us. Thank you. Ms. Norris, we've heard arguments that consumer protections at the state level lead insurers to stop writing homeowners insurance policy in certain states. The insurance multifamily property owners buy usually doesn't have the kinds of protections, as you know, and the oversight that a homeowner's insurance policy would. How is the coverage multifamily policies include different from the coverage a homeowner would buy, number one? And second, are you seeing fewer insurers offering multifamily coverage across the country?
Thank you, Senator Brown. Yes, we are seeing, first I'd like to highlight what was already mentioned about just the impact of climate change, to your point. As an example, national church residences, our 3 highest claims we've had in our history have happened in the last 2 years. One was from Hurricane Ida in August of 2021, $6.5 million for our organization. Hurricane Ian, which hit a single property in Florida and required us to vacate the property for 6 months and rebuild it at $13 million. And a winter storm Elliott, which hit 44 of our communities. It's a really challenging time to be providing affordable housing. And so we see in the insurance market, our insurance is covered at a national level, so we work with carriers that go across state lines. But we are, in fact, seeing fewer and fewer options available for us. In fact, in our previous renewal, we had 4 carriers that worked with us on our property and casualty. 3 of those walked away and left us with a single carrier and basically a take or leave it on the premiums.
Thank you. Mr. Heller, I wanted to thank you for raising concerns around nonprofits having difficulty finding affordable property insurance coverage. I appreciated that in your testimony. I've long raised similar concerns, including at last year's insurance hearing. I'm hoping we can find a resolution to that. So thank you for that. Mr. Heller, you noted that raising insurance rates, reducing coverage, don't reduce risk. It reduces risk for the insurer and who shifted onto the homeowner. What can we do to actually reduce risk so that we can bring down costs and make homeowners and renters' properties safer?
Well, thank you, Mr. Chairman. There are really several things. I mean, we are doing, in some ways, a lot of this work with the Building Resilient Infrastructure Communities, the BRIC program at FEMA. There is some new data that was just released about where we need to invest most aggressively to provide the most return on those infrastructure investments around 500 different census tracts in the country. So we need to take the front end of the solution as serious as we've historically taken the back end by having FEMA emergency funds after a disaster. So that's what we really need to be doing, is putting our money up front. And I'll tell you one thing we have that could be done very simply. Senator Feinstein and Representative LaMalfa have bills that would make grants to homeowners tax-free for home hardening. And that's something we could easily do. I know in California the Earthquake Authority wants to be giving money out to people to strengthen their homes, but people are going to bear the tax burden of that, so that money isn't free, and it's not going to help them rebuild. So we need to make those investments on the front end. If we protect homes with $1, we don't have to rebuild with emergency funds with $5, $6, and $7 after the fact.
Thank you. My time's expired, but Ms. Norris, I want to just offer this committee's help on knowing it can be difficult for nonprofit operators to access resources for mitigation in ways that we can creatively work together. Senator Scott.
Solved, especially by those who have much more resources to work to come to solutions with the staff.
Thank you. Thank you, Mr. Chairman.
Thank you, Senator Rounds. So let's get a 2-part question. You started your career at FDIC. Independent financial regulator before we were lucky enough to have you on our staff. You've been nominated to serve on another independent financial regulator in CUA. Discuss why it's important for financial regulators to be independent, and tell me at the same time, same answer, what will some of your priorities be?
Thank you for the question, Senator. The safety and stability and the resiliency of our financial system is important to the strength of our entire economy. And so I think financial regulators like the NCUA should be independent to promote market stability, predictability, and continuity. Americans need to have confidence that decisions that affect the financial system that affect their pocketbooks, are made independently and based on data. At the same time, I think congressional oversight of those independent agencies is important, so that regulators are held accountable to the American people. If confirmed, I will work to ensure that the NCUA fulfills its mission to protect the credit union system. One priority I would like to focus on, if confirmed, however, is to make sure that credit unions, especially smaller ones, can continue to stay competitive and provide affordable financial services to their members in a constantly evolving financial system. Small credit unions serve a lot of areas of this country that are that do not have access to financial services in the same way as other parts of the country, and so I think that's really critical to the strength of our overall economy.
Thank you. Ms. Fain, you have 2 decades of experience. Talk about how IG offices can promote transparency and efficiency in agency operations and agency programs, and tell us some of the lessons you've learned from various IG offices you've worked with.
Thank you, Senator, for the question. Transparency is very key, if not a critical component of the Inspector General mission and office in general. One way that Inspector Generals are able to contribute is through the reporting that they do, and it's key because oftentimes you have agencies and with programs and operations that can be opaque. And so the reporting that the Inspector General's offices complete and issue not only to Congress but the agency head and are available to public provide that inside look and understanding that taxpayers may not necessarily have with regards to the agency's operations. With my experience of 22 years with the inspector community, what I take from that is just the overall mission and the ability to have an impact on other people's lives beyond oneself. Personally, I like to fix things, and so I take great gratitude and in the work that I've been able to conduct throughout my career and make recommendations to agencies and departments that have provided solutions and instances where those agencies and departments can continue to build and do what they do best for the American public.
Thank you. Mr. Oyuda, you heard what Ms. Fain said about transparency. I'm not sure you understand the outrage by people in stock buybacks. Senator Vance and I have been intricately involved together on what happened in East Palestine with the train derailment. You may not know details, but you certainly know of it. What led up to that, in large part, is that Norfolk Southern laid off a third of its workforce in the preceding years. Executives took stock buybacks. Executives issued stock buybacks, took them to the tune of between $2 and $3 billion. Yet you voted against better disclosure of cyber attacks and stock buybacks. I don't really understand why, in light of what Ms. Fain said and what we know, that disclosure shines a light and makes people behave better often, including railroad executives. Why would you do such a thing?
Chairman Brown, first off, let me express full agreement that transparency is a very key part of the securities laws. And I think one of the fundamental parts is that for the capital market, especially material financial information needs to be disclosed. In those 2 particular rules that you raised, share repurchase and cyber security, there were a number of technical approaches that I had significant concerns for. For instance, on the cybersecurity rule that you mentioned, for the first time, the SEC actually mandated forward-looking statements, which is very unusual for us to do for a particular type of disclosure. Normally, our disclosure are based on things that you can prove as fact. That's one thing we look at on our enforcement efforts. So I had significant concerns about the forward-looking statement part. I realize my time is up. May I continue? I've just finished my thought on share repurchase.
Sure, of course.
With respect to the share repurchase part, we've had disclosure for a while, but the daily disclosures came out that are filed at quarter end were fairly prescriptive, more prescriptive than what we normally do. But I also had fairly significant concerns about how we're making a philosophical change on how we regulate foreign private issuers.
Okay. Thank you for your response. The president of the Richmond Fed told me many years ago, the former president, he said, watch what we do and let us know you're watching what we do. And you understand that. Senator Vance, Ohio.
All right, thank you, Mr. Chairman, and thanks to the six of you for being willing.
For joining us, Senator Rounds will be ranking member today. Welcome back. He's done that before.
Thanks, sir.
I like the relationship. I'd like to thank Senator Sinema for her years on the committee. In her service, she is moving to the Appropriations Committee. I welcome Senator Butler from California. She unfortunately, soon after being sworn in, she is sick. Nothing serious, but we'll be back likely next week. We're excited to work with her. The committee meets today to consider 6 nominations, 4 of whom are renominations. Ms. Tanya Otska to be a member of the National Credit Union Administration Board. Welcome. The Honorable Mark Ueda, nominated to be member of the Securities and Exchange Commission. Welcome back. Honorable Spencer Backus, whom I served in the House with, renominated to be a member of the Board of Directors of Ex-Im Bank. Welcome back, Congressman Backus. Ms. Jennifer Fain to be Inspector General of Federal Insurance Deposit Corporation. Welcome, Ms. Fain. The Honorable Claudia Slazak, renominated to be a Director of the Securities Investor Protection Corporation. Welcome back, Ms. Slazak. And the Honorable William Brodsky, renominated to be Director of the Securities Investor Protection Corporation. Welcome back, Mr. Brodsky. We thank the nominees for appearing today. We especially thank them for their willingness to serve, in the case of pretty much all of you, to continue to serve your country. These nominees will play an important role in the success and stability of our financial system if confirmed. We look forward to that. I would like to talk for a moment about each. I will spend more of time talking about the one of the 6 that I know the best, who has served this committee, is actually still serving this committee and is not used to sitting there looking in this direction. And her parents I met her parents and her husband and her young son, Adrian, and her sister today. The President's nominated Tanya Otska to be a member of the National Credit Union Administration Board. She would be the first Asian American to serve on that board in the agency's 53-year history. She's exceptionally well qualified. She served as a key member of my Banking and Housing Committee staff. She crafted legislation. She provided strategic advice on banking issues and credit union policy. Understanding she is no longer doing credit union issues for the committee now that she's been nominated. She's a career public servant. She first joined this committee in 2019 as a legislative fellow detailed from the FDIC. She became a permanent member of my team in 2020, where she currently serves as senior counsel. Within days of her joining the committee, coronavirus pandemic endangered our financial system. Ms. Otska immediately got to work with then Chair Crapo's staff. I was ranking member at that time on critical provision of the CARES Act, and that so that our credit union system would remain strong and viable and stable as it has. When our financial system was tested earlier in the year by the largest bank failures since 2008, Ms. Otska worked to keep committee offices informed about the rapidly evolving situation. She was in constant contact with regulators and other stakeholders. She's played a pivotal role in legislation advanced by the committee this year, including, surprise to many, the Recoup Act to hold failed big bank executives accountable. We voted out of this committee, again, a surprise to people, that we could work together on something so contentious and difficult that many banks didn't want. We passed it out 21-2. Ms. Otska has played a big role in that, and I thank her for that. River City Federal Credit Union out of San Antonio wrote to the committee. We appreciate Tanya's work to raise the visibility of credit unions, remove barriers to growth, and support credit unions in deepening their impact in the communities they serve. Michael Edelman, whom I know, President and CEO of the Ohio Bankers League, wrote, while we may have differed on specific policy decisions, Ms. Otska always did her homework, gave OBL and other interested party a fair shake. She welcomes a diversity of views. She's the type of regulator we ought to have in these critical economic positions. Congratulations on your appointment, Ms. Otska. President has renominated Mark Ueda to a full term on the SEC. He served as a board member of the commission since last year. Prior to his confirmation, Mr. Ueda was detailed to then-ranking member Toomey's staff from the SEC. He first joined the SEC in 2006. He served in several roles, including counsel for Commissioners Paul Atkins and Michael Pivovar, as well as senior advisor to Chair Jay Clayton. Early in his career, he worked in private law practice as well as for the California Department of Corporations. Welcome back, Mr. Ueda. President's renominated Congressman Backus to the Ex-Im Board Bank. Spencer Backus first joined Ex-Im as a board member in 2019, along with Judith Pryor and then Chair Kimberly Reed. He played an important role in helping reopen Ex-Im after an unfortunate 4-year partial shutdown. For 22 years, Congressman Backus represented Alabama's 6th District. He joined the House of Representatives the same day I did many years ago. He was chair and ranking member on that committee. Good to see you again, Congressman. President's nominated Jennifer Fain to be Inspector General of the FDIC, a role that carries great importance given the recent bank failures. She brings years of audit, inspections, evaluations, and investigations experience, including in the areas of financial services and consumer protection. She possesses extensive experience in federal government oversight, serving in several agencies' Inspector General offices. More recently, she served in senior leadership roles at Ex-Im Bank Office of Inspector General, notably as Deputy Assistant IG for Inspections and Evaluations. Prior to joining Ex-Im, she served as in IG offices at HUD, FHFA, and the U.S. Election Assistance Commission. Glad to see you, Ms. Fain. Thanks for coming. We also consider the nominations of 2 qualified nominees to the Board of Directors of the Securities Investor Protection Corporation's Claudia Slazak and William Brodsky. Both nominees have significant financial services experience. Ms. Slazak possesses some 30 years of financial services experience, both in the public and private sector. The Senate confirmed her by voice vote to the SIPC, to the SIPC board last year. She currently serves as chair. Prior to serving on SIPC, Ms. Slazak was the chief banking officer at Export-Import Bank. She served in senior level roles at several large banks before entering public service. Glad to see you again, Ms. Slazak. Last, Mr. Brodsky possesses 5 decades of securities and investment business experience. The Senate confirmed him to the SIPC board last year, similar to Ms. Slazak by voice vote. During his career, he's worked in senior level roles at several major exchanges, including the American Stock Exchange, the Chicago Mercantile Exchange, and the Chicago Board Options Exchange, where he was chair and chief executive officer. Welcome, Ms. Brodsky. Mr. Brodsky, thank you for joining us. If all of you would please stand for the oath, please. Oh, I'm sorry. You make your statement. Earlier this month, the world watched in horror as Hamas committed brutal acts of terrorism against the people of Israel. Hamas murdered innocent women and men and children. They attacked teenagers at a music festival. They took hostages, families, kids. All of us are horrified. In the days and weeks that followed, the United States has taken strong, swift actions to support Israel as they defend their country against terrorism and to aid civilians in Gaza. Now it's vital to our national security that we provide critical assistance to Israel, including robust military, economic, and humanitarian aid desperately needed for those harmed by Hamas's terrorism. We must stand with both Ukraine and Israel as they fight back against 2 of the world's biggest threats, Putin and Iranian-backed terrorists like Hamas. This isn't a time to play politics. We must stand united with our allies. We must defend American interests. We need to confirm key national security nominees who play a critical role in working with their Israeli partners. We've had too many delays already. Right now, politics holds up several key positions. The ambassador to Israel, at least 12 key military personnel that directly impact that part of the world, preventing important work in the Middle East. It's why people think Washington doesn't work. Political grandstanding, especially as we've seen in the House, but way more than that, is hurting America's ability to effectively protect our interests at home and abroad, keeping talented ambassadors and career military personnel on the sidelines. On this committee, as the ranking member knows, Senator Kennedy knows, Senator Tester knows, We have a long history of keeping politics out and working together to address threats from Russia, North Korea, and China and Iran. In the aftermath of October 7th, we're again confronting a challenge to the civilized world. Our humanity compels us to combat terrorism and to hold state sponsors of terrorism, like Iran, accountable. We must be clear. We must speak with one voice. There's no justification for terrorism, none ever. On this committee, we have a unique role to play, working to understand the financing behind Hamas's attacks so we can work to cut off funding for terrorism at its source and work to prevent future attacks. Iran has an alarming history of supporting terrorist proxies engaged in unspeakable atrocities. It's clear they provide significant funding for the military wing of Hamas. They provide training, they provide capabilities. We will assess what additional economic tools we need to stop state sponsors of terrorism, including Iran, from supporting Hamas, Hezbollah, Palestinian Islamic Jihad, and other terrorist proxies. We'll examine multiple terrorist funding streams, including cryptocurrency. We'll consider additional measures to stop the flow of these funds. In response to the brutal and horrific attacks last week, the Treasury Department's Office of Foreign Assets Control imposed additional sanctions on key Hamas terrorist group members, operatives, and financial facilitators located in Gaza and elsewhere, including Sudan and Turkey and Qatar and Algeria. This action specifically targeted those managing assets within a secret Hamas investment portfolio, a Qatar-based financial facilitator with close ties to the Iranian regime, a key Hamas commander, and a Gaza-based virtual currency exchange and its operator. That is not enough. The administration must take additional steps to impose sanctions and dedicate resources toward a multilateral effort to coordinate with allies to track and to freeze and to seize any Hamas-related assets and take steps necessary to deny Hamas terrorists the ability to raise funds. We need to not only identify the bad actors, but identify their money pipelines so we can shut off their funding. We must undertake a more robust approach to identifying and preventing transactions that take place not only through financial institutions, but also through trade-based money laundering, cryptocurrency transactions, and other channels designed to avoid detection. On this committee, we've raised the alarm about crypto and its role in illicit finance, including the use of crypto to fund terrorists and enable rogue nations financing them. Crypto platforms too often don't use the same common sense protections that keep illicit money out of the traditional banking system. Safeguards like knowing their customers or suspicious transaction reporting. Some crypto services and tokens even help users keep their transactions anonymous. And when law enforcement attempts to trace or block crypto funds, it becomes a game of whack-a-mole. They stop one transaction and criminals move on to another platform with another alias again and again and again. Terrorists know they can use crypto in ways they can never use dollars. It's why President Trump's Justice Department warned back in 2020 that terrorist groups, including ISIS, Al-Qaeda, the military arm of Hamas, were raising funds using cryptocurrency. Not surprisingly, after the attack, it was reported that Hamas had raised millions of dollars in crypto to fund their operations. We need to crack down on the use of crypto to fund terrorism and evade sanctions. Last week, Senator Warren and I, along with more than 100 of our colleagues of both parties, wrote to the administration to voice concern about these issues. I'm glad that members of this committee, including Senator Reid and Senator Warner, have put forward bipartisan plans for closing gaps around digital assets and our illicit finance rules. These are important steps forward. I welcome more ideas from anybody on this committee and anybody at the witness table and anybody in the audience. We will work together on this committee in a bipartisan way to make sure terrorists and bad actors can't exploit crypto. This committee and the Senate have a bipartisan history of combating the ways in which Iran threatens the region, not just nuclear weapons development, but also its support for terrorism. There's been a steady drumbeat recognizing the need for the United States and our allies to maintain and ramp up sanctions on Iran's harmful and destabilizing activities. The Senate voted overwhelmingly to support the Countering America's Adversaries Through Sanctions Act to impose sanctions on Iran and North Korea and Russia. We passed the Hezbollah International Finance Prevention Amendments Act, which imposed sanctions on Russia, Iran, or any other foreign government supporting Hezbollah. And don't forget, this committee acted together, tightened the rules around anonymous shell companies, which too often operate here in the U.S. and which fund criminal syndicates and terrorists alike. We strengthened our money laundering rules and our sanctions tools in a bipartisan way. We will do it again. We need a comprehensive approach to shutting off Iran's funding sources, not just the $6 billion, but the many more billions of dollars Iran uses to continue its destabilizing activities around the world. Now's the time to act. I look forward to working with colleagues in this committee to stem terrorist financing, to address the problems posed by crypto, and to further strengthen sanctions. Ways that come to your organization for help, I know, with consumer financial issues, to the CFPB because it understands perhaps better than anyone the complicated financial landscape and because it acts quickly. To both of you, and answer as short as you can, please. What would it mean to service members, veterans, and their families if CFPB were gutted? Mr. Titus.
Like I said before, Senator, it's frightening, and we're going to see an increase in them going after service members, veterans, and their families.
Ms. Ruska.
I would agree. It would be frightening.
Thank you. I thought it was so telling. A number of you have talked about outside of Wright-Patterson Air Force Base or other major Air Force bases, the number of fly-by-night financiers, if you will, that were there, and that number shrunk with the interest cap. And from your question or answer, Ms. Titus, it sounded like that number would go up again if that happened. Second question. Service members, has been pointed out by witnesses, report more cases of identity theft than other types of consumers. It's why credit monitoring is so important for service members. And credit monitoring, for example, will alert active duty members of material changes to their report. Mr. Titus, do active duty military always get the free services from the credit reporting agencies that they're entitled to?
They are eligible for free credit monitoring. They do not always get it, Senator.
Do you have any idea of any percentages or roughly?
I haven't seen any data on that, Senator, but I think this is something we should be striving for all service members to be using these free monitoring.
Certainly many don't then.
Absolutely.
Credit reporting agencies clearly need to do more. We brought them, first time ever in front of this committee, we brought the three major agencies here. We will, next time they're here, really pin them down on these issues. They need to do more to ensure service members get the benefits they're entitled to. Just last month, CFPB, again, the agency that could step up here, fined TransUnion when it failed to place or remove credit freezes in a timely manner for service members. Congress and the CFPB will continue to hold these private members. This committee will, and CFPB, to hold them accountable. Last longer question. According to CFPB, failure to invoke SICRA reduced rates cost service members $100 million over the last decade. Mr. Titus, currently do most financial institutions automatically apply SICRA interest rate reductions for all accounts, mortgages, auto loans, credit cards? Do they apply SICRA interest rate reductions for all accounts for service members?
No, Senator.
They simply don't apply it even though it's the law?
Yes, Senator.
If creditors, you want to comment on that, Ms. Ruska?
No, sir.
Okay. If creditors proactively checked to identify accounts service members had with their institutions, would more service members therefore get interest rate reductions and save money?
Yes.
Okay. Any comment on that?
We should be making it as easy as possible for service members to get their benefits and protections. When a service member is being called up and activated, they have a lot on their minds. They're worried about making sure their family's taken care of. They're worried about the mission that they're about to do. And doing bureaucratic paperwork to get their SICRA interest rate reductions is important, but it goes along with a whole list of other responsibilities that they're trying to take care of, Senator. So as easy as we can make it for them, that's what we should be striving to do.
Senator Rounds was right in his opening statement when he talked about the importance of financial literacy. But I think that as right as he was, that falls short of enforcement of the law and making sure that these service members and these veterans and their families have a way in a very busy life. My wife's a writer, and she talks about the daily mess of life, and we all face that. People that are financially strapped or trying to make all these. I mean, the military's never been particularly good at helping in that transition from active duty to veteran status, whether it's connecting with the VA, whether it's financial transactions they are about to make, all of those things. So we know that there's so much to do there. Two credit card issuers proactively check, at least two, proactively check to identify accounts that are eligible for SICRA reductions. I'm going to work towards ensuring that all financial institutions check for SICRA reductions, and service members and families deserve nothing less. The testimony of all three of you have helped to make that case. Thank you. Senator Britt of Alabama is recognized.
Thank you, Mr. Chairman. Appreciate it. As we head into Veterans Day next week, it is especially fitting that we have this hearing today.
Come to order. Thank you for our 8 witnesses today. Senator Scott, thank you for your work on this. The 8 bank CEOs appearing before us today lead the biggest global, systemically important banks in the United States of America. Your banks hold nearly $15 trillion in assets, manage trillions of dollars of investments and retirement accounts, fund the biggest companies in our country. You hold nearly half the nation's deposits, more than $80 trillion in client assets. Your banks touch almost every aspect of our financial system in working Americans' money, even if they are not your customers. All of that makes you 8 of the most powerful people in the country. The banks you run are so large, so complex, so interconnected that their distress or failure could pose a threat to the entire global financial system. You may be private companies, but the risks you take and the mistakes you make don't just affect you. They don't even just affect your customers, not even just your shareholders, not even just your workers. Mistakes you make affect the whole economy, and as we all remember from 2008 and 2009, they can certainly affect American taxpayers. That amount of enormous power should also come with enormous responsibility. A big part of that responsibility is to make sure that investors, not taxpayers, are on the hook when risks at your bank don't pay off. That's why we need strong capital requirements at the biggest banks. Because of this committee, we finally have financial watchdogs in place who are now serious about the need for these protections. Common sense rules to ensure that banks can withstand losses from the riskiest financial shenanigans that create no value to the real economy. These rules protect against risky trading and derivative activities on Wall Street, the same activities that led to the 2008 financial crisis. They would close a loophole that allowed banks like SVB to hide behind an accounting fiction that lowered capital requirements and contributed to its failure. And anyone who had any doubt about whether Wall Street could be trusted to use its power responsibly need only look at the current lobbying fight on this. If you've watched the local news in Washington, if you've waited at a bus stop in Washington, if you've flown out of Washington National Airport, you've probably seen ads urging people to stop Basel Endgame. The 8 of you surely know your audience. And you haven't stopped there. You've even gone national in that campaign, pouring money into ads for Sunday Night Football. It's a campaign waged by your lobbyists to prevent financial watchdogs from putting in place these stronger capital requirements to protect our banking system and our economy. Listening to these ads, you hear all kinds of claims about how stronger rules will raise the cost of mortgages and stop small business from making loans. Wall Street banks are actually saying that cracking down on them will, quote, hurt working families. Really? You're going to say that cracking down on Wall Street is going to hurt working families? You're really going to claim that? The economic devastation of 2008 is what hurt working families. The uncertainty and the turmoil from the failure of Silicon Valley Bank hurt working families. When small businesses with their employees in Ohio, in Utah, in Minnesota, and California, and Rhode Island, and Montana, and South Carolina, across the country didn't know if they could get access to their money and make payroll. And of course, the claims in this ad campaign simply are not true. Your game too often is to try to confuse people. Most Americans think of a bank's capital, if you force people to think about it at all, most Americans think of a bank's capital as money stashed away in a vault somewhere. But that's not what it means. You all know that. Capital is just a way to fund loans and investments and risky activities in a way that can absorb losses if things go south. It means shareholders and investors are on the hook, not taxpayers. And what those glossy ads don't tell you is that your banks have been reducing your lending to small businesses and veterans and home buyers for years now, long before the new capital requirements were proposed. Remember that. These are proposals at this point. They haven't even been implemented. Be clear, absolutely nothing in these rules would stop your banks from making loans to working families, to veterans, to homeowners, to small businesses. Absolutely nothing. The reason banks might make fewer of these good loans in the future is the same reason we've been seeing less and less productive banking activity for years. It doesn't make your banks as much money as the risky stuff. You know that. We all know that. You'd rather fund risky trading and derivatives bets than boring bread and butter small business lending. So even with this rule, you can still lend to small businesses and homeowners. You just might not increase your profits quarter over quarter by quite as much as you increased them last year. But I think most Americans would agree that that's a fair trade-off for society. More small business lending, more first-time home buyers, less chance of taxpayer bank bailouts. In exchange, maybe smaller executive bonuses and a teeny tiny bit less profit for multi-trillion-dollar Wall Street banks. We know the banking industry doesn't give up without a well-funded fight. Wall Street pours money into high-priced lobbyists to fight any effort to put the most basic guard rules on your ability to do whatever you want. What your banks want is to maximize quarterly profits. We understand that. The cost of everything and everyone else be damned. We've seen over and over what a problem that is and the harm that the current system does in places like Ohio. Earlier this year, when I first heard about SVB's collapse, my mind immediately went to another crisis in my state in East Palestine, Ohio, the place where the train derailment happened and affected dramatically a community in my state. They have one thing in common. Corporate lobbyists for years pushed for weaker rules, less oversight. Companies cut costs. They don't care about safety if it gets in the way of increasing profits. Working people, always working people pay the price. That's why people hate Wall Street. That's why people hate Washington, because these lobbying campaigns that you've engaged in usually work. We see it over and over. We saw it during the fight to pass Dodd-Frank after the financial crisis. Many of us remember the quote from an industry lobbyist after the president signed Dodd-Frank. Now it's halftime. This time Wall Street was true to its word. The executives whose banks failed this spring had lobbied for watered-down rules to make it easier to chase profits at all costs. They knew risks were building at their banks, but they chose to ignore those risks because it meant a bigger payout for executives at the top. So we should be concerned when the executives of even bigger banks are doing the same thing against capital requirements. Working Americans are tired of arrogant executives gambling with other people's money, then riding off in the sunset without any consequences. That's why we need to pass the Bipartisan Recoup Act. Thank you, Senator Scott, for your work on that, to hold failed bank executives accountable for driving their banks into the ground. It's why we need strong capital rules. Before your protest, I know, of course, that it wasn't your banks, the 8 of you, that failed. But after those failures earlier this year, we were reminded about how fragile our banking system could be, and as a result, your banks only got even more powerful. So it's fair to take stock of how you're using that power. I appreciate the long overdue increases in wages and benefits for many of your frontline employees. Thank you for that. At least one of your banks has made real efforts to get rid of overdraft fees. Thank you for that. But your banks need to do far better when it comes to meeting customers where they are and recognizing their dignity of work, your employees and your customers. You should be cutting prices for consumers, increasing opportunities for your employees, increasing diversity with your executive ranks, supporting your workers' efforts, if they so choose, to unionize. And you should stop pouring money into lobbying against efforts to protect taxpayers who in the end subsidize your entire industry. The reason for this hearing every year is to hold the biggest banks accountable to the American public. I thanked each of you for being here a moment ago personally. I appreciate you're all coming together for this hearing. We want to hear from you. What will you do to support workers, to invest in the real economy, to finally put Wall Street to work for Main Street? A productive third quarter for your banks. Your banks, as you like to say, return capital to shareholders in the form of dividends and stock buybacks. During your earnings calls at the end of the third quarter, we heard statements about how you're going to continue to manage your businesses to deliver value to your shareholders. Of course, what we did not hear was any concern that your firms would not be able to meet the anticipated increased capital levels under Basel III Endgame. If I'm mistaken, I would like you to set the record straight for the public and the investors. Do any of you have any reason to believe that your firm would not be able to achieve the increased capital requirements if Basel III was adopted as proposed? Any of you think you cannot you cannot achieve the increased capital requirements? Raise your hands if you think you can't. Thank you. I think you've indicated your firms will be able to meet the enhanced capital requirements. It leads me to conclude that the proposed capital standards are not too onerous. Mr. Scharf, American support for unions, as we've discussed, is at a half-century high. Unions help ensure that workers share in a company's success through better pay and better benefits, control over their schedules, greater stability to their personal and professional lives. Workers at 2 Wells Fargo branches will be voting to unionize this month. Dozens of other union organizing drives are in the works. Wells Fargo's recent scandals highlight the pressure that overworked and underpaid workers at short-staffed branches face. One worker said the executives don't have to deal with the consequences of their decisions in a direct sense, but we do. Mr. Scharf, I appreciate your willingness to talk one-on-one about this with me. I remain concerned about unfair labor practices and reports that Wells Fargo is geared up in response to the union campaign. Will you remain neutral as these employees vote to organize?
Chairman Brown, I agree with your sentiment about the importance of the workers and our employees. And as you know, we've done a tremendous amount to support them and will continue to do that. And we believe that it's best that we have a direct relationship with those employees, and we do intend to exercise our right to speak with them to make sure that they make an informed decision.
Thank you. It was an opportunity to show the American public truly a new day at Wells Fargo. I'm sorry that you failed to show that real change is afoot at your bank. Mr. Scharf, Mr. Moynihan, Mr. Diamond, and Ms. Fraser, according to the CFPB, failure to invoke the Service Members Civil Relief Act interest rate reductions cost service members $100 million between 2007 and 2018. You can unilaterally act to ensure service members receive those benefits, the escrow benefits they're entitled to. Do your banks proactively check authorized military databases to identify accounts that may be eligible for escrow protections? Begin, Mr. Scharf.
Chairman, we have huge respect for those that have been in the military. Specifically, to your question, I'm not sure, but certainly we'll check and get back to you.
Okay, thank you. Mr. Moynihan?
We again follow the SCRA provisions on an annual basis. We retroactively, looking back after we get notification, about $180 million a year we send back to those service members, including fees, which are not required to rebate, but we go ahead and rebate them. So I will check to make sure we're looking at all available means, but we comply with the law.
Thank you, Mr. Diamond.
I'm sure we comply with the law, but it's an opportunity to say that we've hired 18,000 veterans in the last couple of years. We support the United States military. We've hired 3,000 military spouses. So we stand 100% behind the class of citizens we hold in the highest regard.
Thank you. Ms. Fraser?
Similarly, with Chair Brown, we are very proud to employ many veterans, and we're incredibly grateful for everything that they do for our country. We make extensive investments in ensuring that we comply with the laws, and we do indeed tap into the database.
Thank you. Thank you for your candor about that. I urge you all to proactively check whether customers are eligible for escrow benefits. It's the type of work that you could be doing. The answers were helpful, and we will be back with all 4 of you about how we can help do that proactively. There's plenty we don't agree on. It's pretty clear. But I also want to finish somewhere we do agree. Supplemental security income. SSI provides a lifeline for 300,000 Ohioans, nearly 8 million Americans living with disabilities. The problem is SSI's eligibility rules haven't been updated by Congress. That's on us. In 40 years, they're now so outdated they lock people in poverty. The Bipartisan Policy Center called SSI's asset limit the most regressive anti-savings provision in federal law. I have a bipartisan bill with Senator Rounds of this committee to raise the program's asset limit and stop punishing people for working and saving. Mr. Diamond, I know J.P. Morgan Chase is supportive of raising the asset level. I thank you for your leadership on this. Tell us briefly how it affects J.P. Morgan and why you're so supportive. Then I'd like to ask all of you if you would join Mr. Diamond and Senator Rounds and me in support. Mr. Diamond.
Senator, thank you. We have employees who don't want us to increase their salary because if it goes over a certain amount, they can't get that benefit, which they're entitled to. Or they can't have assets over $10,000. So this definitely should be fixed. We fully support it and try to be helpful if we can.
Thank you. Mr. Scharf, would you agree to support Mr. Diamond's position and mine?
It sounds like something that we'd be willing to support, but I'd like to take a look at it.
Okay. Mr. Moynihan? Ms. Fraser?
Fully and wholeheartedly.
Okay. Mr. Hanley?
We do support it.
Thank you. Mr. Vince?
We do support it.
Mr. Solomon?
We do support it.
Mr. Gorman?
Yes.
Thank you all. Senator Scott?
Before you today, and I look forward to your questions.
Thank you, Director. Thank you for your ongoing work on protecting workers' hard-earned money. I want to discuss something that we've talked about privately, many in this committee have asked about. And one of the real highlights of what CFPB does is the Service Members Civil Relief Act. We passed it to provide active duty service, just generally what you're doing with service members, but specifically we passed it to provide active duty service members with the financial relief. It guarantees service members and their families a reduction in interest rates on any pre-service loans. My first question is, Director, would you say that all service members are receiving the benefits that Congress intended for them to have?
No, they aren't. And in fact, we saw the destructive impact of that years ago with the illegal foreclosures of active duty military families in violation of the Service Member Civil Relief Act. You know, with a higher rate environment, they are entitled to a 6% cap on pre-service obligations, and we do not see many of them always getting it. We estimate that fewer than 10% of eligible auto loans and 6% of personal loans to activated members of the Guard and Reserve were getting those rate reductions.
So what can financial institutions be doing to ensure that they get the financial benefits that Congress intended?
Well, certainly many of them are starting to just give it automatically. They can often know if a service member is activated, and they can do it rather than making the service member go through an obstacle course of paperwork.
Okay, thank you. I'm going to work towards ensuring financial institutions proactively check for SICRA reductions. Our service members and families should be able to keep their money, as you've continued to fight for. Thank you.
And on the Military Lending Act, we've pursued more actions and we are litigating there to go after the egregious repeat offenders. The Military Lending Act is one of the most important protections, not only to protect those families, but as the Department of Defense would share, our force readiness as well.
Thank you. This committee is particularly with credit agencies, have talked a lot about medical debt and what we do. The complexity of medical billing, coupled with the vulnerability of consumers seeking to obtain and finance medical services, creates opportunities for abusive, maybe that's the wrong word, for abusive practices by predatory medical debt collectors. Discuss what actions CFPB will take to hold medical debt collectors accountable when they attempt to collect bills that are not owed or engage in other unfair, deceptive, and abusive practices.
Well, we've already been taking some actions on the enforcement front, but there's going to be more. We've conducted quite a bit of analysis about medical debt. And you know, this is not like a normal loan. You don't sign up like a credit card or a mortgage. It happens to you, and then often a bill is put on your credit report, even if you've paid it, even if the insurance company has covered it, and you're stuck in the middle. Many people end up just paying it to get rid of it, and we are exploring whether it's even appropriate, given the widespread inaccuracies with credit reporting, whether it should be on credit reports at all. Many financial institutions will tell you that data is often not even predictive at all, and it should not be used to coerce people into paying something they don't owe.
So walk through, I mean, when we've had the three major credit agencies in front of this committee, we've done it 2 years in a row. It's a practice we started and will continue to do, talking especially, one of the main topics has been medical debt and what it does to consumers, as you just explained. Some 10 million Americans have had their credit histories harmed by medical debt. Talk more specifically, and then my last question, about walk through what that rule, what you are working on to fix that. If we can't get the credit agency to do the right thing, they've taken steps, but not enough. Tell me what you would do.
So the three credit reporting conglomerates have already taken steps to remove certain amounts of the debt. we are proposing or exploring rules that would limit credit reporting of certain medical bills. We're collecting feedback from small businesses right now about it. We've been talking to the medical industry, hospitals, medical debt collection, providers, and we may, although we have not made any firm conclusions, propose a rulemaking to restrict the reporting of medical bills on credit reports.
Thank you, Director. Senator Scott.